happened? I'm having. Okay. Okay. Yes. Okay. The recording has started. So, apology for starting behind the schedule. You understand, is always due to the internet and some other technical issue we normally face when we are doing this kind of virtual events. So I don't want to take much of our time. I don't know if the zonal chairman is here. Yes, who is speaking? Please meet everybody to meet himself. Meet yourself. Meet yourself. Meet yourself. Oh. Meet yourself. Okay. So if the zonal chairman is not here, we'll
I'm here.
Address us.
I'm here now.
Are you here?
I'm hearing you.
Okay. I did see. I'm sorry. So you can just give us your opening remark.
Okay. Good morning, our professional colleagues.
My zonal chairman,
appreciate
please.
your. Good morning, our professional colleagues. We appreciate your presence for this our quarterly webinar, and we appreciate your support for all the inputs that everybody put together for it to be alive today. We appreciate you. We appreciate the active option as well. All the facilitators that are on grant. I can see Mr. Ayuba Kodri. So you are appreciated. Odewale and everyone that are hooked on, we appreciate you. So, and I believe that we all enjoy it. Let's stay tuned and wait till the end of the program. We appreciate you. Thank you all. Thank you for coming. Thank you for joining it. Thank you.
Okay, thank you, our zonal chairman. So, because time has long been passed, we may not be able to do most of the protocol that we need to do. In as much that the zonal chairman has declared the program open, I will just invite my brother, Mr. Alaji, to Alaji Kodri Ayuba to take on the floor immediately. Alaji Ayuba, are you there? Alaji Ayuba, and we've been here since so. Alaji Ayuba,
I'm there and I'm very much ready for the presentation.
Okay. So let me just do a brief introduction of Alaji Kodri Ayuba, which every one of us, most people know very, very well. He's the immediate past chairman of ICANN and ICANN Ibadan District Society, and the president, chairman and CEO, Triumph Professional Study Hub, one of the award-winning ICANN Professional Study Center nationally in Ibadan. Alaji is man of many parts, but because of our time, I won't be able to do much regarding that now. So without much ado, let me invite Alaji Ayuba to please continue on his paper presentation. Over to you, sir.
Thank you, Mr. Odewale. My sincere appreciation.
Go on, we can hear you. Go on, Mr. Ayuba, we can hear you. Is there anything wrong?
Let him unmute himself.
Okay, let me unmute him here.
You can hear me? Can you hear me now?
It will be an error.
Can you hear me?
Okay, we can hear you. Yes, we can hear you. Yes, clearly.
So I use this opportunity to congratulate all our Christian brothers and sisters. I wish them happy Good Friday. And at the same time, our brothers and sisters in Islam, Jumat Mubarak and Ramadan Kareem. Well, this paper presentation today is a commendable one. And before I will start this paper, I need to let the attendees to know that we will have many papers to present today as we have it in the timetable. While I will be presenting 7 out of the 15 papers, I will enjoy the cooperation of every one of you. It is when you cooperate that we can really understand ourselves. And at the same time, I will assume zero knowledge. Anything that is not clear to you when we start the presentation, I will appreciate it if you can just bring it to my notice by the time there is an opportunity to ask questions. Now, beside that, the first paper we are going to present today is International Accounting Standard 1, which is titled Presentation of Financial Statement. The accounting standard, we can see it as the cornerstone of all other accounting standards because it is a kind of international financial reporting standard that other accounting standards rest upon. So that's why we see it as a cornerstone of all other international financial reporting standards. And it's going to be the first one we are going to present today. But as a professional, as we have it in the Professional Code of Conduct, professional competence and due care, professional competence and due care. I will be showing a due care to you if I should tell you a kind of constraint that we have on this paper presentation we are making today. And that constraint is the time. The 30 minutes that is allocated to each paper may not be enough for most especially International Accounting Standard 1, International Accounting Standard 19, and International Accounting Standard 37. However, I will cover all the 7 accounting standards within the stipulated time, within the time that have been allocated to all the papers I'm going to present. So what I'm saying in essence is that the time I will spend to present International Accounting Standard 1 will be around 45 minutes or 50 minutes, where we will be able to save more time on what? On IAS 10, IAS 34, and IAS 8, we'll be able to save time from those ones. But International Accounting Standard 1, I need to be sincere to you, there is no way we can complete it within the, stipulated time. So let me now share the screen so as to start the job. And I will be navigating when there is the need for it, for proper explanation of the presentation. Now, ladies and gentlemen, I believe you can see the screen I have shared with you. Have you all seen the screen?
We can see it.
Sir.
Yes, sir. We can see it, sir.
Yes, the screen is clear. I can see.
I can see it, sir.
Thank you. Okay. Now, when we are talking of International Accounting Standard 1, presentation of financial statement, it's an accounting standard that all other accounting standards rest upon. And this International Accounting Standard 1, presentation of financial statements, what do we need to know? It is needed by all organizations, regardless of whether you are a manufacturing sector or you are service-oriented organization. You need this accounting standard, because without this, we cannot present or we cannot prepare financial statement in accordance with the provision of what? International Accounting Standard 1. So it is when we apply this International Accounting Standard that our presentation, give me 1 minute, please. One of the participants is trying to get some information from us here. I'm very sorry for that. Go and attend to this. Call, tell them that somebody wants to.
If they put it on
Now,
chat, I'll be attending to
gentlemen.
them. Hello?
Okay. Okay, you have been attending to
Don't
them.
call me. If they put it on chat, I'll be attending to them. Just go straight forward on your own.
Let someone else attend to them, please.
Okay. Now, ladies and gentlemen, as far as
That's
this
what I said,
international
that you
accounting
should
standard
continue.
is concerned, these are what we are going to be looking, the agenda on the accounting standard, the introduction of the accounting standard, the scope, the purpose, what do we mean by fair presentation, what is the accounting policies, core concepts in the accounting standard, structures and contents, and other disclosure. Now, ladies and gentlemen, to start with, the principal way of preparing financial or providing financial information to external users is through the annual financial statement. Now, when we are talking of annual financial statement is not the same thing with annual report. When we are talking of annual report has non-financial information and financial information. The non-financial information, we have a lot of things: corporate governance, risk management, this integrated reporting, environmental reporting, directors, chairman report. All these are part of annual report, but they are not financial statements. The financial information of the annual report is the financial what? Is the financial statement. And financial statements are the summary of the performance of an entity over a particular period and its financial position at the end of that particular period. So when we are talking of how the performance, the summary of how the business has performed together with its financial position, that is what we are going to see in the financial statement. So financial statements are designed to meet the needs of a wide range of users and therefore are not tailored to the need of any particular user group. Like, you know, we have so many users group or users of financial statement or stakeholders, as we have shareholders, we have creditors, we have customers, we have government, we have public at large, and so on and so forth. All these, they need the financial statement for one purpose or another. But the financial statement that is prepared in accordance with the International Financial Reporting Standard, we take care of the need of these people. So it is that one financial statement that is prepared by the company that all users is not going to be making use. So when we are talking of this word, it is not tailored to the need of a particular user group. That is why under International Accounting Standard 1 and the revised conceptual framework of financial reporting, that is why they refer to that financial statement as general purpose financial statement. It is being referred to as general purpose financial statement because it is that one or single financial statement that will serve the purpose of all the users. So they refer to it as general. So when we are now talking of general purpose financial statement, do we have specific purpose financial statement? Yes, is the answer. There is a specific purpose financial statement. When we prepare, when you want to take bank loan, bank will require you to prepare a particular statement that will be submitted to them before they can assess your credit worthiness, before they can assess whether that money can be given to you. And that is specific purpose financial statement. You can't present such statement to your customers. You can't present such statement to government. You can't present such statement to shareholders because it will not serve their own purpose. But general purpose financial statement that is prepared in accordance with International Financial Reporting Standard, we have it under International Accounting Standard 1 and conceptual framework. It's a kind of financial statement that will serve the purpose of all users. And it is not tailored towards the need of a particular user group. Now, what is the purpose? The purpose of the financial statement is to provide financial information about the financial position, financial performance, and cash flow of the business. And when we are talking of to provide financial information about financial position of the business can be depicted by the statement of financial position. Financial performance can be depicted in the statement of profit or loss and other comprehensive income, while the cash flow is going to be depicted in the statement of cash flow that will show inflow and outflow of cash to the business. So that is the purpose of preparing what? Or the purpose of that International Accounting Standard 1, to prepare financial information about financial position, financial performance, and cash flow of what? Of the business. And what is the objective of this accounting standard? The objective of this accounting standard is to provide basis for the presentation to ensure comparability. It also looks into the minimum content and structure together, and it is not the format, most especially for this statement of financial position. The format is not rigid at all for the presentation of the statement of financial position. Even if we have a format for the income statement, we have the format for the statement of what changes in equity. We have a specified format in IAS 7 for the statement of cash flows. There is no particular format we can employ for the statement of what? Of financial position. And I've made mention of the scope the other time. The scope is to apply this International Accounting Standard 1 to the preparation of general purpose financial statement. And the general purpose financial statement is a kind of financial statement that is not prepared to be tailored to the need of a particular user group. It's a statement that is going to be used by all the users. It is made applicable to all, available to all of them. And it is that same financial statement that all of them will be making use. Now, when they are talking of the objective to ensure comparability, what do we mean by that comparability? The objective of International Accounting Standard 1 is to ensure that, well, we compare the performance of one entity from one period to another. Let us take, for instance, ABC PLC is the name of the company.
Mr. Ayuba.
ABC PLC Financial,
Ayuba.
yeah.
Can you scroll your screen? People want it to be. They want your screens. You scroll it to the page you are talking about. They just see the first page. As in your slide.
I think I have changed it. Okay, there is no problem. I will change it. But I have changed it to the
just
second
first
slide.
Page that is showing.
The first page.
Oh, it's not reflecting. Yeah, it's only first page that we are seeing now.
Okay. But I've changed it.
It's not reflecting.
It is static.
It is static.
It's static.
Yes, it's not moving.
Yes.
Just fixed there.
You can make it in the presentation mode. Yes. Click the presentation mode so that it will bold.
Okay.
Yes. Change now. Yeah. Good content. Change it to presentation mode. That last button, that button at the base.
So it is the presentation mode that does not change it. But you can see it now.
Okay. Go ahead.
Okay.
Yes, we can.
So the objective of the financial statement, as I have explained, is that we will be able, the financial statement is prepared so as to be able to compare the performance of an entity. Let us say we have ABC PLC, year 2022, year 2023. What is the performance of ABC PLC in year 2022 compared with the performance of ABC PLC in year 2023? This is one of the objectives that International Accounting Standard 1 wants to ensure. Not only that, we can be able to compare the performance of one entity with another entity. But if we want to compare the performance of one entity with another entity, we should ensure that those entities we are comparing together, they are operating in the same industry. Let us take, for instance, Guarantee Trust Bank. The performance of Guarantee Trust Bank can be compared with the performance of Standard Chartered Bank. It can be compared with the performance of what? First Bank. It can be compared with the performance of what? Wema Bank. So this is one of the things, the objective that International Accounting Standard wants to accomplish. So comparability of the financial statement, whether based on trend analysis or based on cross-section analysis. Based on trend analysis, we are talking of when you are comparing the performance of an entity in different years. When we are talking of cross-section analysis, we are talking of comparing the performance of two or more entities that are operating in the same industry. And that is one of the objectives that is going to be accomplished with this International Accounting Standard 1. And we have talked on the purpose already. We have there that said that the purpose of this International Accounting Standard 1 is to ensure that, it is to apply it to the preparation of general purpose financial statement. And I have told you what we mean by general purpose financial statement. A financial statement that is prepared, but it is not tailored to the need of just one user. It is tailored to the need of all the users. And it is that one statement that everybody will make use. So, and we have specific purpose financial statement, but International Accounting Standard 1 does not have anything to do. It doesn't deal with specific purpose financial statement. As I've said earlier on, you need bank loan. Bank may require you to prepare profit, to prepare what? Cash flow forecast. To be able to assess whether you are going to be credit worthy. To be able to know whether that money you have, you have desired to get from them will be given to you. So that is for what? General purpose and specific purpose what? Financial statement. Such statement cannot be used by other users of the financial statement. But let me tell you, financial statement that is prepared in accordance with International Accounting Standard 1 is general purpose that can be used by all categories of user group. So that is for that. Now, ladies and gentlemen, under International Accounting Standard 1, we have overall consideration. Among the overall consideration, we have fair presentation there. What do we mean by fair presentation? But this fair presentation we are having is one of the overall consideration. However, we can even talk of core concepts as well. We have 7 core concepts while we have fair presentation that stands on its own. If we pick this fair presentation with other 7 concepts, we call them overall consideration. Now, what do we mean by fair concept? You all know that as external auditors or as users of financial statement or readers of financial statement, if we pick annual report, we go to this word, audit report section. At the end of the report, we always have that statement there. The financial statement shows the true and fair view. Now, when it is stated there that the financial statement shows the true and fair view, that true and fair view is exactly what we mean by fair presentation. But this issue of fair presentation we are talking of is a term that is used in another client. It is a term that is used in another jurisdiction. In Germany, they don't talk of fair presentation. They talk of fairly presented or presented fairly. In UK, they don't talk of fair presentation. They talk of true and fair view. In Nigeria, here we talk of true and fair view. What do we mean by true and fair view? Now, fair presentation implies that the financial statement presents fairly or alternatively in some jurisdictions, present a true and fair view of the financial position, financial performance, and cash flow of an entity. So fair presentation requires faithful representation of the effect of transaction and other events and conditions in accordance with the definition criteria for assets, liabilities, income, and expenses laid down in International Accounting Standard Board. Now listen attentively. When the financial statement is going to show, it's going to be fairly presented, or it's going to show true and fair view, that means the management must have selected the appropriate accounting policy. They must have made appropriate disclosure requirements, disclosures. They must have applied all the relevant international financial reporting standards to the preparation and presentation of financial statements. And if they have done all this, financial statement is going to be said to what? To show true and fair, or to be fairly presented. Now, in that situation, when the financial statement is said to be fairly presented, so this true and fair view we are talking of, it's a legal term. It is not defined even at getting at all. In that low legal, it's not defined at all. But some group of professionals, they come together to coin a meaning of true and fair view. And they now see true and fair view as a situation where the financial statement is what? Is accurate and free from material error. When the financial statement is accurate and free from material error, that is when we say that the financial statement shows true and fair view. And the financial statement can be accurate and free from material error if we have shown the appropriate disclosure, if we have applied, we have selected appropriate international financial reporting standard in its preparation, and if we have selected relevant accounting policies to the preparation and presentation of that financial statement. Let us say, for instance, if you are preparing account for bank and other financial institutions, you can't say you want to apply International Accounting Standard 41, because International Accounting Standard 41 is accounting for agriculture, and it is not applicable to that particular sector. So when they are talking of selecting, applying relevant international financial reporting standard, it must be not all international financial reporting standard can be applied to the preparation and presentation of a particular financial statement. It depends on the nature and operation of a business before we can know and the type of accounting standard, international financial reporting standard, that the reporting entity or the management of a particular reporting entity will select. Now, true and fair override. True and fair override. In extreme circumstances, if management believes that compliance with a particular requirement of the international financial reporting standard will be misleading, that it will conflict with the objective of financial statement that will show true and as laid down in the framework, then the entity is allowed to depart from what? From that requirement of IFRS, provided the relevant regulatory framework does not prohibit a departure. What we mean in essence is at times, when you apply a particular international financial reporting standard or a particular section of it, financial statement may not show the true and fair view. And if the financial statement does not show the true and fair view, the objective of international accounting standard one has been defeated. Financial statement must. So if a particular application of a particular compliant with a particular requirement of IFRS will not make the financial statement to show true and fair view, we have to do what? We have to depart from the application of that particular requirement so as to ensure that financial statement shows true and fair view. And by the time we have now departed from the application of that requirement, there are certain disclosure requirements we are going to make. Number one, management, we have to show that the impact of such departure on each period presented. And we have, number two, we have to show that, okay, we have departed from the application of a particular word, application of a particular international accounting standard. And we still need to state there that we apply certain international financial statement has been prepared in accordance with the international financial reporting standard, other than the one that we have departed from. And management must show it, must, present it, they must disclose that, despite the fact that they have departed from what? The application of a particular section of IFRS. The international the financial statement shows the true and fair view. Whatever the standard you have departed from, you must also make the disclosure for it as well. So these are the disclosure we are going to make. If there is the need for us to depart from the application of a particular requirement that will not make the financial statement to show the true and fair view. Now, after this one, accounting policies. Accounting policies. Accounting policy is international accounting standard A that we are going to do what? We are going to still present immediately after the presentation of the statement of cash flow. However, these accounting policies we are talking of, we have it under international accounting standard 1. It is the duty of the management to select and apply accounting policies so that the financial statement complies with all international standards and its interpretation. Now, if there is no specific standard for a particular item, management should choose policies that are relevant and reliable. We will still come across this one under what? Under international accounting standard A. However, when we prepare financial statement, there are notes to the account. Among the notes to the account we are going to make is accounting policy. The first note we are going to make when we prepare financial statement is this issue of what? Explicit and unresearched statement of compliance. When you have, let us assume that we have a particular reporting entity, and that reporting entity can apply all international financial reporting standards that we are having now, starting from IAS 1 to IAS 41 and IFRS 1 to IFRS 17. Let's say we have a typical entity that can apply all those international financial reporting standards. If that particular entity does not make explicit and unreserved statement of compliance, it's like they have not applied any international financial reporting standard. So there must be what? A statement of explicit and unreserved statement of compliance with what? In the note to the account, and there must be what? Significant accounting policies as part of the note we are going to make in the financial statement. Now, after this one, under international accounting standard 1, we have component of the financial statement. We are going to have it in the what? In the next slide, or one of the slides in this presentation. Component of the financial statement. In accordance with that international accounting standard 1, any financial statement that is prepared, are you getting me? In accordance with IAS 1, must have that 5 components. They are 5. What are the components of the financial statement? Number 1, we have statement of financial position. That is your normal balance sheet, your formal balance sheet. We have statement of profit or loss and other comprehensive income. We have statement of changes in statement of changes in equity. We have statement of cash flows, and we have explanatory notes to the account. These are the 5 things we have. And when we have annual report, these are 5 things that make up the financial statement in the annual report. Because I said the other time that financial statement is not the same thing with annual report. Financial statement is integral part of the annual report that will show the financial information about the reporting entity. Now, ladies and gentlemen, how is there a way by which we can identify all those 5 financial statements that I have mentioned? Is there a way to identify them? Yes, is the answer. There are a way by which we can identify financial statement in the annual report. All other statement, all other things we may have in the annual report, we not have that file. And what are those things that we can use to identify financial? We call it identification of financial statement in the annual report. The first thing we can use to identify financial statement is what? Name of the reporting entity. Name of the reporting entity. So when we say name of the reporting entity, let me demonstrate what I mean by that. Assuming you have ABC PLC, statement of financial position as at December 2022. Now, ladies and gentlemen, we must have what? We must have 5 things to identify any component of financial statement, as I've said. The first one is name of the reporting entity. So when you prepare statement of financial position, you prepare statement of profit or loss and other comprehensive income. You prepare statement of change in equity. You prepare statement of cash flows and note to the account. There must be name of the reporting entity. Number 2, there must be reporting period. Reporting period is the second item you can use to identify components of the financial statement as at 31st of December 2020. If it is income statement, it will be for the year ended. Statement of cash flow for the year ended. Statement of changes in equity for the year ended. Note to the account for the year ended. So any of these 5
No, no. Hello, Mr. Ayuba. Did you mute yourself? Please unmute yourself. Can you hear me, Mr. Ayuba?
I hear you. I have unmuted myself.
Okay, you muted yourself before. You can go ahead.
I don't mute myself. I don't know what must have happened.
So what happened? But you are okay now. You can hear you. Just continue.
Okay.
You can continue.
ABC PLC, name of the reporting entity, reporting period, currency of presentation, making number 3. Level of precision. Level of precision, that is level of rounding in million naira. If it is in 1,000 naira, you have something like this. That is level of precision or level of rounding. That is number 4. These are 4 things we can use to identify financial statement. The 5th one, it has to show there whether the company or the company is an individual company or it is a group company. With this, you can't say this is a group company. We say ABC PLC. If it is a group company, we will have ABC Group, or we say consolidated. So after a consolidated there is showing you that this is a group company. If it's an individual company, there will be nothing like that will show that this is a consolidated financial statement. So, ladies and gentlemen, these are 5 items we can use to identify any component of the financial statement. And let me tell you, the 5 components of the financial statement that we have mentioned, right from today on, go and check any annual report. You will discover that in the statement of financial position, in the statement of profit or loss and other comprehensive income, statement of cash flow, statement of changes in equity, and explanatory note to the account, you are going to have all these 5 things there. There is no other statement in the annual report that will contain all these 5 things. So it is important that we are able to identify financial statements in the world, in the annual report. Now, after this one, the next thing to move to are the core concepts. Core concepts. We have 7 core concepts under International Accounting Standard 1. The first one is going concern. The second one, we have accrued basis of accounting. So I will firstly talk on the first one, core concept. Financial statements should be prepared on the assumption that the business will be in the world, will be in fact continue when management are convinced that there are no material uncertainties that may pose threat. Well, what we mean by going concern is an assumption that the business will continue to be in operation for the foreseeable future. Foreseeable future in accounting does not mean forever. What the foreseeable future means in accounting is a situation whereby you cannot accurately determine the number of years in which the business is going to span. there is a way by which this going concern can be applied. Every day we apply. When we are entering into a business relationship, we apply it, but we may not know. When you want to obtain bank loan and you enter into an agreement that with bank that way, I will be paying this loan back in the next 10 years. It is a good application of going concern in practice. The impression you are creating is that your business is not going to collapse in the next 10 years and far beyond, and so on and so forth. When you buy an asset, and you now say that this asset that we have acquired, we are going to use it in the next 5 years. We are going to depreciate you over 5 years. The impression you are creating is what? Going concern assumption. You are creating the impression that, well, your business will continue to be in operation for over 5 years. Your business will not liquidate. Are we okay? And so on and so forth. Now, accurate basis of accounting. Accurate basis of accounting is a kind of, concept. One of the core concepts where the transactions and the effect, they will be recorded, they will be recognized. Not when the cash is received or paid, but when those transactions occur. So there will be different times by which this was the cash that is received and the transaction will occur. We don't say that they cannot occur together. They can occur together. But in a situation whereby there is going to be a kind of a credit transaction, we will record the credit transaction despite the fact that we have not collected money or we have not paid money on such transaction. So that is what the cash basis. The transaction and the event are recognized when they occur, not when the cash flows. So that means the time that the transaction occur and the time that the cash will flow, they differ. So that is for what? Accurate basis of accounting. The next one is consistency of presentation. Now, when we are talking of consistency of presentation, the presentation and classification of items in the financial statement should be retained from one period to the other. Accountants are not expected to be behaving like a chameleon that will classify one particular item in 1 year in which in another year they are changing. Accountants should not be behaving like a chameleon. Accountants should retain whatever the presentation and classification method they have chosen over the year. But there could be a change if that change is going to make the financial statement to be more relevant and reliable, or a change is required by international financial reporting standard or an interpretation, because nothing lasts forever. What is good today may become bad tomorrow. So that is why there is no rigidity in this issue of consistency of implementation. Even if we have said that we should be consistent, we should not be behaving like a chameleon. If a change is going to make our classification and presentation to be more relevant and reliable, or it is required by IFRS, we have to effect that change. And that is what is addressed under International Accounting Standard 8. Changes in accounting policy, changes in accounting estimates, and thereabout. It is going to be one of those accounting standards we'll be presenting today. Materiality and aggregation. Now, when we are talking of material being, a particular item being material, when we say the item is material, what it means is that when you mistake that particular material or you omit such material in the financial statement, it can change. It's going to change the economic decision of all the users. Their perception about that economic decision will be changed if you change. Are you getting me? So that's what we mean by what? Materiality. Now, ladies and gentlemen, what is the general rule of this materiality as we have it under International Accounting Standard 1? The general rule of what? Materiality in the conceptual framework and under International Accounting Standard 1 is that any material item must be separately disclosed in the financial statement. It must be separately presented in the financial statement. And we can have the similar item. The similar item must be separately what? Must be separately presented as well. However, when we have immaterial item in the financial statement, immaterial items, they are expected to be aggregated together before they are now presented as one. Let me give you an instance. When you say stationery, stationery is not just one item that we can be referring to as stationery. It is because of the immateriality of those items. When you buy pencil now, you buy eraser, you buy sharpener, you buy blade, and you are making use of, you buy ink, pen. All these things, they are immaterial items. The money involved is very small. You can't say you want to be recording pencil from exercise book, from eraser, from pen. They are immaterial items. All of them must be aggregated together. We are now going to present them as what? We give them one name to capture them. We call it what? Stationery. That is what? An aggregation of immaterial items before they can be presented in the financial statement. So note again, Material item is said to be stated to be presented separately. The similar item should be presented separately, while immaterial items are expected to be grouped together. They are expected to be aggregated together before they can be presented in the financial statement. Now, the next one, we have offsetting. Assets, liabilities, income, and expenses should not be set off against each other. Let us assume that we have cash balance and we have bank overdraft when we maintain different types of accounts. When we have cash balance and we have what? Bank overdraft in different types of accounts. International Financial Reporting Standard mandate us that to ensure transparency, we should show bank balance and we should show bank overdraft separately in the same financial statement. The principle behind that is that these balances we are having, we may not be having them in the same bank. So let the people know that you are having overdraft somewhere. However, when the offset is permitted by International Financial Reporting Standard or interpretation, we can offset. Offsetting is permitted under International Accounting Standard 12. Are we okay? Offsetting is permitted under International Accounting Standard 19. When we are having present value of defined obligation and we have fair value of planned asset under International Accounting Standard 19, it can be offset. The two can be offset. But if it is not required by International Financial Reporting Standard or interpretation, we are not expected to offset items of asset and liability, income and expenses. Are we okay? Just like the example of cash balance and bank overdraft that I've mentioned. Are we okay? So that is for that. Now, beside this, we have comparative information. Comparative information. So what do we mean by comparative information? Comparative information, when we prepare financial statement, you will see that we don't just prepare financial statement of a particular year in isolation. We need to compare with the financial statement of the other year. The two will be juxtaposed. That is the requirement under International Accounting Standard 1. Like this 2023, company will start to be rolling out their financial statement. By the time they prepare financial statement for 2023, you will see that there will be financial statement for 2022 that is going to be juxtaposed with it. So it is the requirement of International Accounting Standard 1 that we should be able to compare the financial statement of the previous period with the current period. Though it is 1 year that we normally compare, nothing stops us from having it more than 1 year in the financial statement. But the only thing is that if you now want to be having more than 1 year in the financial statement, that cost may be too much. That is why it is limited to what? It is limited to 1 year. And last but not least, on this one, core concept, we are talking of frequency of reporting. Now, when we are talking of frequency of reporting, what do we mean by frequency of reporting? What we mean by frequency of reporting is that, well, what is the time interval that the financial statement should be prepared? Ordinarily, financial statement should be prepared at the end of every 12 months, which is what? Which is 1 year. However, the financial statement can be prepared for less than a 1 year. It can be prepared for more than a 1 year. A typical business that has just started operation is having a window of 18 months to prepare its first year annual account. So such company can have a financial statement that will be more than 1 year. A typical business that is ceasing may have a financial year of less than 1 year. Are you getting it? However, if the financial statement that is prepared is less than a period or more than a period of 1 year, the reason why it is more or less than that has to be given in the financial statement. And not only that, we have to give the information that that particular financial statement cannot be compared with 1 year financial statement. So that is the frequency of what? Of reporting. Ordinarily, it should be 1 year. Now, beside this, we have component of the financial statement, as I've said earlier on. So when we are talking of component of financial statement, as I've said, we have statement of financial position, we have statement of comprehensive income, we have statement of changes in liquidity, we have statement of cash flows, and we have notes to the account. Now, ladies and gentlemen, in accordance with the chapter 4 conceptual framework for financial reporting, we have 5 elements of the financial statement. The 5 elements of the financial statement are assets, liabilities, income, expenses. Asset, liability, income, expenses, and what? And equity. To prepare statement of financial position, we need the 3 first items, which are asset, liabilities, and equity. Those are the elements of the financial statement that we use to prepare statement of what? Financial position. The income and expenses are used to prepare what? Statement of profit or loss and other comprehensive income. And a statement of changes in equity, that is any changes in what? In the shareholder on equity. That is what we report there. Together we item under other comprehensive income. At the same time, statement of cash flow is going to look at what inflow and outflow of the changes in the cash flow position of the business over the year. While note to the account, we show so many significant accounting policy and so many explanatory notes that will make the users and reader of the financial statement to understand that financial statement better. Now, a full set of international financial statement comprises the following statement. That the statement that must be shown with equal prominence to each other. So none of the statement takes precedence over the other one. They should be shown, are you getting me? With equal what? With equal prominence. So that is the component of the financial statement that we have in International Accounting Standard 1. Now, structure and content. Structure and content. Now, ladies and gentlemen, when we are talking of the structure and content, under International Accounting Standard 1, it is stated that assets there should be distinction between current and non-current assets in the financial statement. There should be distinction between current asset and non-current asset. Current assets should be separated from non-current assets. Current liability should be separated from non-current liability. But if these current and non-current, if the liquidity position, showing them in the liquidity position is going to make the financial statement to be more relevant and reliable, we are going to make use of this liquidity position. So when we show it in liquidity position, there is no need to differentiate, to distinguish between current and non-current. Let us say, for instance, bank and other financial institutions, insurance company, they don't show current and non-current when they present their financial statement. They will only show it in liquidity format. So, but when we show current, non-current, we now start with non-current, end it with current. International Accounting Standard 1 does not stipulate that we should start, and we end it with non-current. What IAS 1 tells us that though we are having this order of permanence, so when we want to arrange it in order of permanence, we can use it in that order. Are you getting me? And at the same time, minimum content for the statement of financial position, the statement of profit or loss, statement of changes in equity, we have the minimum content under International Accounting Standard 1. Like in this statement of financial position, we are going to have property, plant, and equipment, investment property, biological asset, financial assets. Are we okay? We have current assets there. Under with the current asset, we have something like inventories, we have trade and other receivable, we have cash and cash equivalent. We go to the section of this liability, we have them there as well. We have the ordinary share capital, general reserve. We have what? Retained profit. Are we okay? We have financial instrument as a liability. We have bank overdraft. We have tax payable. All these are part of what we should have with the minimum content in the statement of financial position. But that does not mean that we cannot have more than that if the situation permits. In the statement of profit or loss as well, we have the minimum content there, ranging from the revenue, talk of the profit from the associate, talk of finance costs, talk of taxation, other comprehensive income. We have all these as part of the minimum content in the income statement. However, we can have more than that. The statement of changes in equity, all the items we have in the statement of financial in in other comprehensive income, they are going to be part of the component of the statement of changes in equity. In accordance with the International Accounting Standard 8, when there is going to be any change in accounting policy, are you getting me? Any component of the equity that is going to be affected by the changes in accounting policy or the correction of prior error, all these are part of what? They are part of the statement of component of the statement of what? The statement of changes in equity. Any dividend that is paid during the year is also part of the statement of changes in equity, and we have the format for what? For the statement of changes in equity. We have the format for the statement of profit or loss. We have the format for the statement of what? Financial position in the world under International Accounting Standard 1. Now, beside this, as far as the requirement for the preparation of the statement of cash flows is concerned, nothing is stated on the statement of, we don't have the format for the statement of cash flow, which is only mentioned under International Accounting Standard what? International Accounting Standard 1. The preparation and presentation of what? Of the statement of cash flow, it is International Accounting Standard 7 that has provided guidance of that. And IAS 7 is going to be the next accounting standard we are going to present after this International Accounting Standard 1. And you have to note it. This statement of cash flow is the only statement that is put here without applying this accrual concept that we have under International Accounting Standard 1. Now, ladies and gentlemen, in statement of profit or loss is prepared using what? Two approaches. The first one, we have nature of expenses and we have function of what? Of the expenses. We have nature of the expenses and we have what? Function of the expenses. So this is the nature of, we have nature of the expenses. Now, this function of the expenses is the one that is common for any type of the organization. But when we are talking of the nature of the expenses, well, it is only those organizations that are in the manufacturing company that can make use of what? The nature of the expenses for the presentation of statement of profit or loss. Even all these manufacturing companies, they adopt function of the expenses most of the time for the preparation and presentation of the statement of profit or loss. Well, we are talking about the statement of profit or loss and other comprehensive.
Your slide is not changing.
It has changed. You are having structure and content there.
No, sir.
What do you have now?
It's there.
No, it has changed.
It has changed. Now that's what I'm saying here too. It has changed.
Statement of profit or loss is what we have there.
Yes, statement of
Delay
profit and
could
loss.
be the strength of the internet of each person.
Yeah.
Oh, that is you get it.
Let's go, Mr.
So that is yeah. Okay, now ladies and gentlemen, that is the structure and content of the statement of profit or loss. I told you that it can be what nature of expenses and the function of expenses. Then in fact, let me tell you, 98% of the companies we have in Nigeria, all are in the global world, they are using function of the expenses. Though nature of the expenses can also be applied by manufacturing companies, but even the majority of the manufacturing companies that we are having, they are still using what? Function of the expenses for the preparation and presentation of the statement of profit or loss. However, under International Accounting Standard 1, we can be talking of statement of profit or loss, but it is statement of profit or loss and other comprehensive income. Yeah. So this statement of loss and other comprehensive income we are talking of, it can be prepared as a single statement. Not only that, it can also be prepared as two statements. It can be prepared as a single statement and it can be prepared as two statements. Hello. Now, ladies and gentlemen, if it is prepared as a single statement,
can we mute ourselves, please? Like, somebody is making something. Let everybody mute. Oh, okay. I will mute everybody now. Yeah, Mr. Yuba, I muted everybody. You can mute yourself and continue.
What happened the other time? Now, ladies and gentlemen.
Okay, continue. Yes. Can we go to the next one so that we fast?
I told you, and other comprehensive income.
Yeah.
It can be prepared using single method or what? Or two, it can be prepared in 2 steps or single step. That one is going to be, shown later. So the last slide here is what? The note to the account. I don't know whether you have seen it. Note to the financial statement. So now, what are the notes to the financial statement? That is what? The disclosure requirement under what? Under International Accounting Standard 1. The first one is the statement of compliance. It should be disclosure requirement under IAS 1. We have what? Statement of compliance to IFRS, as I said it earlier. If you apply all the existing international financial reporting standard, and you do not make statement of explicit and you don't make explicit and unresearched statement of compliance, is that you have not applied any IFRS to prepare your financial statement. So you must make this statement of compliance with IFRS. It is always number 1 in the note to the account. Number 2, significant accounting policies. Number 3, information for line items presented in the 4 primary financial statements. The 4 primary financial statements we are referring to are this statement of profit or loss, statement of financial position, statement of changes in equity, statement of cash flows. Sources of the estimation, further disclosure like this contingent assets, contingent liabilities, the capital of the business, the dividend that has been proposed, other disclosure like domicile, legal form, country address, nature of operation. We have a lot of disclosure requirements under what? International Accounting Standard 1. Now, ladies and gentlemen, this is the last slide there, but that is not the end of the presentation of this accounting standard. Now, I made mention of the fact that This international accounting standard we are talking of, IAS 1, we have other comprehensive income there. Other comprehensive income. So under International Accounting Standard 1, we have other comprehensive income. What the other comprehensive income there are? Number 1, revaluation surplus. Revaluation surplus or deficit is the first item under other comprehensive income. Number 2, we have actuarial gain or loss. Or loss in accordance with the provision of International Accounting Standard 19. Number 3, we have foreign exchange gains or loss on foreign subsidiary in accordance with the provision of International Accounting Standard 21. Number 4, we have fair value gain or loss on available for sales financial assets in accordance with the provision of International Financial Reporting Standard 9. And we have what? Fair value gain or loss on cash flow hedge. On cash flow hedge. So these are the 5 components of what? Other comprehensive income in accordance with the provision of what? International Accounting Standard 1. 5 components. 5 components of other comprehensive income. So these are the 5 components of other comprehensive income that is going to be added to the profit.
Yeah, Mr. Iba, please mute or mute yourself. I muted everyone before. There are a lot of noises.
Now, ladies and gentlemen,
behind.
These are the 5 other components, 5 other comprehensive income that we have under International Accounting Standard 1. And to manage our time appropriately, this is where I'm going to draw curtains on the presentation of International Accounting Standard 1. Any other question we might have, when it gets to the question time, I will entertain it. Thank you so much for being wonderful listeners to this International Financial Reporting Standard. Thank you all.
I think we are heading to the next one so that we manage our time towards at least to meet up with. So if anybody has questions, let's find them together. We attend to them, or you can just put them on the chat box. I will try to collect them one after the other, and when the time is appropriate, we bring it on board. Thank you. So, Mr. Ayuba, please go ahead. And let's be mindful of time as well, please.
Hello?
Hello, I can hear you. Can you
Hello,
hear me?
we are with you.
Yes, I'm just joining the meeting now because the link. Are you with me, sir?
No problem. No problem. It was a network issue that duplicated the scheduled time. So, and I've sent the link that they should send it to that other line, that everybody should leave that place. And there's nothing missing anyway, because everything is being recorded since we started, and everyone will have access to it, including the presentation slides.
Okay.
Sorry for that.
So it's recorded. So it's recorded, eh?
All right.
Okay.
Now, ladies and gentlemen, thank you for joining us.
Let's go, sir.
We are moving to the second International Financial Reporting Standard. This one should not take us more than 20 minutes to present. IAS 7. Now, ladies and gentlemen, what do we mean by IAS 7? With what we have presented so far, you will see that the International Accounting Standard 7 provide guidance on the preparation and presentation of the statement of cash flows. And this is one of the components of the financial statement as we have it under International Accounting Standard 1. However, we have it under International Accounting Standard 1. It is only mentioned there. The format together with The guidance to prepare it is in this International Accounting Standard 7. And this is the component of the financial statement that is prepared using cash basis. Now, ladies and gentlemen, our agenda on this background information that I have done, overview, definition of key terms, component of cash flow, method of presenting cash flow from operating activities, and disclosure requirements. Now, we have background information. I have said that it is required to prepare statement of cash flows as one of the financial statements under International Accounting Standard 1. But the guidance for the preparation and presentation of international statement of cash flow, together with the format, together with the method, we have everything under International Accounting Standard 7. And when we are talking of the statement of cash flow, it is purely based on what? The cash that has actually flown into the business and the cash that has gone out of the business. The cash you have received and the cash that you have paid. In inflow and outflow of cash, regardless of what that particular inflow or outflow, might be made on. Now, ladies and gentlemen, definition of key terms under International Accounting Standard 1. Now, the first one, what do we mean by cash flow? We can see cash flow as inflow and outflow of cash from operation. Inflow and outflow of cash from operation. And what is cash? The nature of cash may at first seem obvious, but cash may be held in many forms. Don't just think that the currency you have in your hand alone is the cash. What of the one you have in your deposit? In accordance with the provision of International Accounting Standard 7, cash comprises cash on hand and demand deposit with bank. Now, ladies and gentlemen, if you have a deposit, you have what? Current account, or you have your what? Your normal savings account. Whatever you are having there, they are still qualified to be recognized as cash in accordance with the provision of International Accounting Standard 7. But when you have time deposit, which is fixed deposit is not qualified to be recognized as what? As cash. Because fixed deposit, you cannot just walk into the bank and get it out. Are we okay? There is a restriction on what you can do on the cash that you are having in your fixed deposit account. So fixed deposit account does not qualify to be recognized as cash in accordance with the terminologies, the definition of cash under International Accounting Standard 7. So if you are maintaining till in your working place, the cash till you are having, together with the deposit you have in your bank account, they are qualified to be recognized as what? As cash. But when we are talking of the cash equivalent, we can see cash equivalent as what? Short-term highly liquid investment. Short-term highly liquid investment that are readily convertible to a known amount of cash and are subject to insignificant risk of changes in value. Short-term highly liquid investment that are readily convertible to a known amount of cash and are subject to insignificant risk of changes in value. But it is stated under International Accounting Standard 7 that for a particular short-term investment to be recognized as cash equivalent, it must have a maturity day of 90 days or maturity period of what? Of 3 months. Anything other than what? That particular 90 days or 3 months, it is no more qualified to be recognized as what? Cash and cash equivalent. Like when you're having treasury bills, you're having commercial bills, you have this what? You have this issue of what? Fixed deposit that can mature or that will mature within 90 days. We should see them as what? As cash equivalents. So that is the definition of terms under what? Under International Accounting Standard 7. Some forms of cash can be accessed immediately, while there is a delay in accessing others. So those cards that there could be a delay in accessing them, they are qualified to be recognized as what? As cash equivalent. Those ones you can easily access, they are what? They are cash. So we move to another slide. Now, presentation of the statement of cash flows. How do we present the statement of cash flow? Now, under International Accounting Standard 7, the cash flow of the reporting entity can be classified into 3. The first one, we have operating activities, which is the principal revenue producing generating activity for the revenue producing activities for the business. We are coming back to that. After that, we have investing activities, operating activities, that is the principal revenue producing activity of the entity, and other activities that are not investing or they are not financing. If you want to know much of this word, operating activities, your revenue income statement, that part of it that is collected in cash, not the one that is due to be collected. your cost of sales outflow. As we have inflows, there will be what? There will be outflow. Are you getting it? Those income from other means, they are what? Inflow of cash. Any payment we make, all these expenses that are cash expenses in the income statement, they are what? They are operating activities as well. Besides that, we have investing activities. I'm coming to that. And we have financing activities. These are the three categories of activities we have under International Accounting Standard 7. Now, besides this one, we want to navigate so as to be able to explain this International Accounting Standard 7 very well, because it's a short international financial reporting standard. Now, ladies and gentlemen, we have International Accounting Standard 7 statement of cash flow can be classified into three, as I've said. We have operating activities, we have investing activities, and we have what? Financing activities.
Financing.
So these are the three activities.
Financing.
Three activities we have. Now, if you are preparing statement of cash flow now, ABC PLC as the name, statement of cash flows for the year ended 31st December 2023. And we have this. Now, ladies and gentlemen, I will assume that we want to use indirect method first. Indirect method. To use indirect method, we start from what? Profit before interest and taxation. We can as well start from profit before tax, so that we add back interest, we deduct what? Investment income. After this one, we adjust for what? Adjustment for non-cash items. What are those non-cash items we are going to adjust for? This is the area I want you to listen attentively to me. Depreciation of tangible non-current assets must have passed through the income statement. Amortization of intangible assets. Impairment loss on assets, if any. Warranty provision in accordance with the provision of International Accounting Standard 37. Loss on asset disposal. That is okay. Profit first. Loss on asset disposal. Fair value loss. You can see all these items don't involve movement of cash, and they must have passed through the income statement. They will need to be added back. They will need to be added back. Note what I have said here. They can only be added back if they have passed through the income, through the profit or loss. If they have passed through profit or loss, that is when we are adding all these things back. At the same time, we have what? Profit on asset disposal. Profit on asset disposal must be added back to the profit before. It has to be what? Deducted. Provision for warranty that we are talking of. This is increase in the provision for warranty. It must have passed through the income statement as expense. It has to be added back. If you have decrease in what? Decrease in provision for warranty, this is also going to be deducted. If we have fair value gain, fair value gain will be what? Will be deducted as well, provided they have been added before we arrive at profit before interest and taxation. All these will be extended here. It may be negative, it may be positive. It depends on the magnitude of each item that we have here. After this one, we have increase or decrease in working capital. For the increase or decrease in working capital here, what do we have? We have what? Inventory, we have trade and other receivables, we have trade and other payables like owing across, we have interest paid, and we have taxation paid. So inventory will be added back if it decreases over the period. Or let me do it this way. Increase in inventory is outflow of cash. Increase in receivable is outflow of cash. When your asset increases, it's like you have spent more money. So when inventory increases over the period, it is outflow. So increase is outflow, while decrease is inflow. The same thing is applicable to what? To receivable. Increase is outflow, while decrease is what? Is inflow. For payable, increase in payable is inflow, while decrease is what? Is outflow. When you pay your liability, there will be reduction. Cash is going out. So decrease in trade payable is what? Is outflow, while increase is what? Is inflow. Are we okay? Yes, interest paid is outflow, while taxation paid is also what? Outflow. Ladies and gentlemen, this one will be extended there. It may be positive, it may be negative. What we are having here is net cash flows from operating activities. Net cash flow from what? Operating activities. So that is the end of what? Of net cash flow from operating activities using direct method of presentation as prescribed in what? Under International Accounting Standard 7. Now the next thing is to move to what? Investing activities. Investing activities. When we are talking of investing activities, that is just what? The acquisition and disposal of non-current assets. Now, the focus should be on the statement of financial position, the non-current asset part. Non-current assets. For the purpose of the preparation and presentation of the statement of cash flows, the non-current asset can be classified into 3 here. We have tangible, we have intangible, and we have long-term what? Investment. And don't forget, statement of cash flow has to do with inflow and what? An outflow of cash. We can acquire tangible assets. What is the cost that we have paid to acquire tangible assets? So, investing activities. Cost of acquiring what? Tangible assets. That is outflow. We can acquire intangible assets. What is cost of acquiring intangible assets over the year? Is outflow, making 2. Number 3, what is the cost of acquiring long-term investment over the year? It is also outflow. If we can acquire any of these, we can as well dispose any of them off. If we dispose of tangible assets during the year, what is proceeds? Proceeds from disposal of tangible assets during the year. Inflow, proceeds from disposal of intangible assets during the year. Inflow, proceeds from disposal of long-term investment. Inflow. Ladies and gentlemen, as far as investing activity is concerned, your focus must be on non-current assets. Your focus must be on non-current assets alone. The cost of acquiring them, the proceeds when we dispose them off. Are we okay? Besides that, when you're having investment, the purpose of having investment is to generate returns. The 7th item under investing activity is what? Returns. Returns on investment. If the investment you have made is bond, we'll be talking of what? Interest received. Interest received. If the investment you have made is the equity instrument of another entity, we'll be talking of dividend what? Dividend received. All this will be what? Will be inflow. Ladies and gentlemen, and that is the end of what? Investing activity. So investing activity has to do with what? Acquisition and disposal of what? Non-current assets. Tangible, intangible, long-term investment, together with the returns on such investment. So whatever we have there, we recognize it as net cash flows. Net cash flow from what? From investing activity. So this net cash flow from investing activity will be added to net cash flow from operating activity to arrive at what? To arrive at net cash flow before financing. Net cash flows before what? Before financing. Ladies and gentlemen, last but not least, under the statement of cash flow, that is financing activities. As far as financing activity is concerned, as we have done here, under International Accounting Standard 7, financing activity is explained as the changes in the composition of debt and equity. Changes in the composition of debt and equity. So that means our focus should be on the shareholders' fund together with what? Together with our non-current liability. Changes in the composition of debt and what? And equity. That is what? Financing activity. So that means we are going to be looking at shareholder fund, yeah, ordinary share capital, share premium, reserve.
So one bet. Would you send the link is there now? Yeah, to send this one go on post it.
Now, ladies and gentlemen, what do we mean by this? When during the year, if the reporting entity
no, so the network here lo duplicate the
hello,
Mr. Adewale,
can you please mute yourself?
Oh, I'm sorry, please. I'm sorry. I battled with all that thing at the background. Sorry.
Now, financing activities. When you dispose of shares during the year to raise money, that is inflow. Whatever you might have generated from that, we call it sales proceed. Sales proceed or proceed from share issue. From share issue. This will be both nominal and premium, whether it's on ordinary shares, whether it's on preference shares. During the year, you may obtain loan obtained, or the venture that you have raised is inflow of cash. You don't redeem ordinary share, but you can redeem preference share capital. Preference shares redeem. Loan repayment. Loan repayment. Loan repayment will be outflow of cash. Preference share capital redeemed. Outflow of cash. Another one we can have here is what? We can have what? Capital sum. Capital sum on finance lease. In accordance with the provision of International Financial Reporting Standard 16. Capital sum on finance lease. Outflow. And this is finance. Some people are financing your business. Other shareholders are financing your business. Loan providers are financing your business. And they must get return on their what? On their investment. As a result of that, we're talking of what? Surfacing of finance. Surfacing of what? Of finance. So, surfacing of finance can be what? Interest paid. Or what? Dividend paid. Let me put dividend paid here. Don't forget that interest paid has been used up there. So we have two ways by which the interest paid can be used. If you have not used interest paid under the operating activity, you can use it under financing activity. Dividend received can also be used under what? Investing activity. I mean, this was operating activity as well. Now, ladies and gentlemen, when we now sum all this together, we call it what? Net cash flows. We call this net cash flow from what? From investing activity. net cash flow from investing activity. At the end of the day, everything will be strung together. We call it increase or decrease. Increase or decrease. Increase or decrease in cash and cash equivalents. We have balance brought forward. We have balance what? Carried down. So, ladies and gentlemen, this is the what? The format for the presentation of the statement of what? Of cash flows. This is the format. So, and these are what you are going to make use to prepare statement of cash flows. Are we okay? So I want you to master all this very well. All these are put here. You cannot read all this in a textbook. There is no way you can see all this in just a textbook. Even if you are having 10 textbooks together, it may not be convenient for you to come across all what you are having under this what? Net cash flows from operating activities. It is through constant what? Practice and through what? What is applicable in practice that has made me to be able to do or to bring all these items together under the operating what? Activities. So that is what? How, and again, for the investing activities, I told you that your focus is going to be on what? Non-current assets. For financing activity, your focus is going to be on the changes in the composition of debt and what? And equity. And that is exactly what we have had here. Now, ladies and gentlemen, I can now navigate again.
Well done, Alhaji Ayuba.
Thank you.
Yeah. I'm just greeting you.
Oh, thank you so much.
All right.
Now, ladies and gentlemen, before we move on to this.
Any question? Just 1 minute, sir. Any question?
Okay.
I've been receiving some question on the chat something, so I'm collating them. So because some people are just joining now from that erroneous link that was mistakenly sent earlier. So they are just joining us now, just to let them know that this section and subsequent section, they are being recorded and you can have it at the end of the whole webinar, including the paper presented. So there's nothing missing. If you cannot catch up with any statement or any part of the presentation, you can do it at your own pace when you are taking through the recording file that will be sent. So there's nothing missing. Okay. So go ahead, sir.
Thank you, sir. Thank you.
I think we have finished IAS
now,
7 now, right?
It's in the next 2 minutes, it will be finished. The last thing is just
so
to
what
show
next
what
now? What
this was. The last thing is to show how to prepare what, how to get net cash flow from operating activity using direct method. That's the only thing that is left here.
Okay.
Are we okay?
All right. Let's go quickly. Yes.
You're welcome. Now, ladies and gentlemen, how do we get, or how can we calculate this net cash flow from operating activity using direct method? Direct method.
Hello, sir. Hello, sir.
Hello, who is
I can
there?
hear you.
Hello.
Please, there is an urgent issue. That other platform, we still have about 32 people there who are finding it difficult to come into this original platform, and they are raking seriously. So maybe we should send this correct link to all.
I have sent it to them. Some people that are there. Hello.
We still have about 32. I've been sending it individually to them. I've been sending it individually to them again. But we still have about 30 people there.
Somebody that was there, I've sent it to him to place it on that platform, which he
You
told
can resend that.
So some are joining.
I've contacted a lot of them and sent to their private WhatsApp.
No,
I too was there
that's
before.
no,
Yeah,
send
I
it to
don't
the
know why.
chat box of that platform.
Yes,
please.
I also
was
sent
there
it to the
before. It
chat
was
box.
sent to the chat
You
box.
know what? I also sent it to the chat box.
joined from
When
the
they
chat
click
box.
on the chat box, it keep bringing them back to that old one. So I now said every one of them should leave that platform. Probably a new one should now be sent to the mails generally again.
Okay, I will do something now.
Okay,
I
let me
will
just go
create
there and send it to them.
WhatsApp platform now. Hello, sir.
Okay.
I will create a
All
WhatsApp
right.
platform now. Then I will send the link here. Let everybody join when communicating from there.
Okay, better.
Is that okay?
Better. Thank you, sir. Better.
All right. I will do it now. Thank you. Yeah. So let's go, sir.
Now, ladies and gentlemen, sorry for that interruption. It is one of those things. Now, ladies and gentlemen, how do we get net cash flow from operating activities using direct method? In fact, under International Accounting Standard 7, it is the direct method that is required to be used. But we discovered that in practice, it is indirect methods that they normally make use in the preparation and presentation of the statement of cash flows. But, I mean, people are encouraged to use what? To use direct method under International Accounting Standard 7. Now, listen, to use direct method, we have what? Cash received. From customers. Cash paid to suppliers. Cash paid to or on behalf of employees, that is staff, other cash operating expenses. Other cash operating expenses, we are talking of something like stationery, all these expenses that pass through the income statement that are not non-cash items. They are these other cash operating expenses. After that, we have what? Taxation paid. The actual tax that is paid and what? Interest that is actually paid. All these will be summed together as a deduction from cash received from customers to arrive at what? Net cash flows from operating activity. Note, everything being equal, the result we have here, net cash flow from operating activity, must be the same thing as what we have under what? Under this situation. They must be the same, everything being equal. Are we okay? So that is how, and immediately we have got this net cash flow from operating activity. Investing activity and financing activity, they are determined in the same way we have it when we generate our net cash flows using what? Using direct method. Ladies and gentlemen, and that is how we prepare statement of what? Cash flows. Using either direct method or what? Or indirect method. Last but not least, the end result of the preparation of the statement of cash flows is increase or decrease in cash and cash equivalent. One of the requirements we have under International Accounting Standard 7 is that there must be analysis of cash and cash equivalent. It's part of the disclosure requirement we are expected to make. The component of that cash and cash equivalent. So how do we get cash and cash equivalent? How do we analyze it? Let's see how that cash and cash equivalent is analyzed. Now, analysis of cash and cash equivalent. Cash equivalent. We will have opening balance, let me increase the font a bit. We have closing balance, and we have opening balance. Cash in hand. cash at bank, short-term investments that are qualified to be recognized as cash equivalent, bank overdraft, opening balance here, and we have difference, either increase or decrease here. So whatever we are having here, that is our what? Increase or decrease in cash and cash equivalent. So the final thing we are having here is increase or decrease in cash and cash equivalent. So, and this is what I mean. This one, the opening balance is this, while the closing balance is this last one. Ladies and gentlemen, everything being equal, everything will just work like this. So, ladies and gentlemen, that is the statement of what? The statement of cash flow analysis of the cash and cash equivalent. Now, ladies and gentlemen, what are the disclosure requirements? What are the disclosure requirements for this accounting standard? Disclosure requirements. Disclosures. Component of cash and cash equivalent, as I have done it. Reconciliation of the amount in the statement of cash flow with the equivalent items, reported, not I reported, reported in the financial position, and the amount of significant cash and cash equivalent balances that are held, but they are not available for use by the business. So, ladies and gentlemen, thank you so much for your rapt attention. So, we are moving to another presentation. Thank you.
So much. Thank you. I can see people putting their hands together to appreciate you. So, where are we going now? I think we have done 3, right? Am I right?
Yeah.
We have done 3.
The next is to present the
No,
next accounting
we have done
standard,
2.
IAS 8 is the next one.
IAS 8. Okay.
Yeah. Can we attend to question and answer on the first 2, or we should continue?
Let's finish everything, please.
Okay.
Let's finish everything. And as much as possible, let's manage the time. This is already, I think we are past 12 now. I know it's difficult, but we can do something.
Okay.
Oh yeah, go.
International Accounting Standard 8. I want to share IAS 8. Okay.
Yeah, you can share. You have the floor.
Have you seen it?
Yes. I can see it from my end here.
I believe others can see it as well.
Just 1 minute, please.
Yes,
sir. One Bolale Ade. Yes. What's the issue, please? You raise up your hand. Is there anything that needs urgent attention? Hello? If none, let me remove that so that we can go forward. Go on, Mr. Iba.
Now, ladies and gentlemen, this is the third International Financial Reporting Standard, and it is titled Accounting Policies, Changes in Accounting Estimates and Error. It is titled Accounting Policies, Changes in Accounting Estimates and Error. Under International Accounting Standard 1, we said something there. We said that any accounting policy that is selected by the management, there must be disclosure for them in the financial statement. And if you are going to disclose this accounting policy that have been selected by the management, do we mean that accounting policies cannot be changed? Yeah. Again, in accounting, we make a lot of estimates. And if you can agree with me, you will discover that depreciation is an estimate. It's not an actual whatever. Other than the depreciation, write down in the value of inventory is an estimate. The provision for guarantee in accordance with the provision of International Accounting Standard 37 is an estimate.
How are you going to this channel? 23.
Yeah, can we mute ourselves? Can we mute ourselves, please? Can we mute ourselves? I muted everyone now. So, Mr. Yuba, you can mute yourself. I've muted everyone. You can continue now.
Now, ladies and gentlemen, I think I have unmuted myself. Now,
okay, yeah,
what I'm saying
continue.
is that we have many accounting standards. This word, we have so many accounting policies that can be adopted by the reporting entity. Now, ladies and gentlemen, you know, under International Accounting Standard 2, we have the policy. There is a policy there. So many accounting standards, like inventory should be measured at lower of cost and net realizable value. That is what you are going to apply when you have. And at the same time, we have choice of method when it comes to the valuation of inventory under International Accounting Standard 2. As we have what? FIFO method, so we have weighted average method. We can all see this as what we can choose. The reporting entity can select to use any of them. Now, we have some International Financial Reporting Standard that gives us the opportunity to make a choice. And we have some situations whereby we cannot make a choice. Whatever has been prescribed by International Accounting Standard, that is exactly what we are going to make use. So, ladies and gentlemen, presentation, this one, Accounting Standard 8, Accounting Policy, Changes in Accounting Estimates and Errors. What are our learning objectives as far as this accounting standard is concerned? We need to know what do we mean by accounting policy, what is going to necessitate changing accounting policy, how do we effect a change in accounting policy? Are we okay? What are the disclosure requirements we should make when there is a change in accounting policy? We need to know what do we mean by accounting estimates. How are we going to account for the changes in accounting estimates? What are the disclosure requirements we should make on accounting estimate? We need to know what we mean by prior error that have been made in the past years. When we get to International Accounting Standard 10, we are going to see the relevance of the prior error there. Now, ladies and gentlemen, any errors that is made in the past year, after the financial statement has been prepared, after the financial statement has been authorized, and it has been published, annual general meeting has been conducted, and we discover that there is error in the financial statement. How are we going to correct such error? How are we going to account for it? What is going to be the disclosure requirement we are going to make when we have prior error? These and other things are what we are going to be looking at, or we are going to be discussing under this International Accounting Standard, Standard 8. We have our agenda here. Although what I've mentioned, they are still part of the agenda we are going to be looking at. Now, ladies and gentlemen, as far as this International Accounting Standard is concerned, what are we trying to achieve on this accounting standard? Now, ladies and gentlemen, one of what the things we are going to achieve is uniformity and comparability. What do we mean by comparability? If we are changing our accounting policy this year, next year, our financial statement will not be comparable at all. But when there is consistency in the accounting policy that the management has selected over the years, that is when the financial statement is going to be able to be comparable. Whether we want to compare the financial statement of one entity in one period with the other, it is when we have consistency in the application of accounting policy that we can accomplish that. And at the same time, if there is no guidance, if there is no regulation, or there is no standard on how we are going to be changing, what can necessitate the changes in accounting policy, everybody will do what they like. And at the same time, the financial statement that is prepared using different policies over the period will not be uniform. So to achieve comparability and uniformity, this accounting standard is very essential. Now, what is the objective of International Accounting Standard 8? Well, the objective of it, as I've said, is to prescribe this criteria for selecting and changing accounting policy, and the accounting treatment of changing accounting policy and accounting estimates and what? And error. Another one is to enhance comparability over what? Over time and with other entities benchmark. So its scope is to prescribe criteria for selecting and changing accounting policy and the treatment of accounting estimates and what? And error. Why its objective is to enhance comparability of the financial statement over the year. I refer to it the other time, trend analysis, or with another entity, which is benchmarking. So when you want to benchmark your company with another company, you should ensure that they have the same accounting policy. If they don't have the same accounting policy, there will be no basis of comparing the two things together. Are you getting me? So that is exactly what we have as scope and what an objective of this accounting standard. Now, ladies and gentlemen, what and why? What do we mean by accounting policy? We can see accounting policy as the specific principles, basis, conventions, rules, regulations, requirements, and practices that is used by the reporting entity in preparing and presenting financial statements. We have accounting concepts, we have principles, we have rules, we have basis. All these, when we use them for the preparation and presentation of the financial statement, we see them and as well as accounting. In summary, the accounting policy explains the way that an entity treats item within its what? Within its financial statement. So how a particular item is treated is what we see as well as the accounting policy of a particular entity. Are we okay? Now, ladies and gentlemen, what can lead to the changing in accounting policy? Well, in practice, there are three reasons that can lead to changes in accounting policy. But in International Financial Reporting Standard 8 or International Accounting Standard 8, there are two reasons stated under IAS 2 that can make the reporting entity to decide to change its accounting policy. Number one is that when that change is done, when there is a new International Financial Reporting Standard, or there is a new interpretation that has been developed by International Accounting Standard Board, definitely there is going to be a change in accounting policy. Let me give you an instance. When in 2004, when there was this when they released this International Financial Reporting Standard 1, International Financial Reporting Standard 1, which is tied to what? It is tied to what? The first time adoption of International Financial Reporting Standard. You know, but before, when we prepare financial statement, we say land and building. Land and building. The two will be what? Will be compressed together. We have the two together. We show them in the statement of financial position. Even when we are having non-current asset schedule, we still have land and building combined together. But one thing should be clear to you: we don't depreciate land, we depreciate building. We don't depreciate land because land does not have what? Land has indefinite lifespan. It doesn't have a particular useful lifespan. That's why we don't depreciate it, because some people will be saying we don't depreciate land because it appreciates in value. That's not the reason. Other assets can appreciate in value as well. But we don't depreciate land because it does not have a definite lifespan. And any asset that does not have definite lifespan should not be depreciated. Even if it is what intangible asset that does not have definite lifespan, it should not be what? It should not be amortized. Am I communicating? Now, ladies and gentlemen, so as far as that land and building is concerned, International Financial Reporting Standard 1 now tells us that when we have, by the time we are converting international what? I mean, this was a financial statement that has been prepared using what? Using the former SAS that we were using, and we now want to convert into what? IFRS compliant financial statement. We should separate land from building. We should separate land from building. That is the requirement of new International Financial Reporting Standard. And we can see it as well as a change in accounting work, a change in accounting policy. So, ladies and gentlemen, so when there is new IFRS or interpretation, or when the management believe that the financial statement will be more relevant and it is going to be faithfully represented the event, situation, and condition. Those are the two situations we have under International Accounting Standard 8 that can make us to do what? To change our accounting policy. Number one, new IFRS is interpretation. Number two, when it is the belief of the management that the financial statement is going to be more relevant and what? And reliable, the financial statement is going to be relevant and faithfully represented the event. Are we okay? And transaction, we can change what? Our accounting policy. Now, ladies and gentlemen, we have a change in accounting policy. We have a change in accounting estimate. How can we know that a particular change is a change in accounting policy? How can we know that a particular change is a change in accounting what? It is a change in estimate. Ladies and gentlemen, when one of these three is present, that change is a change in accounting policy. Let me give you an instance. If there is a change in the way you are recognizing items in the financial statement, that change is a change in accounting policy. If there is a change in which you are measuring a particular item in the financial statement, that change is a change in accounting policy. If there is a change in the way you are presenting a particular item or transaction in the financial statement, that change is a change in accounting policy. What do I mean by that? In accordance with the provision of conceptual framework for financial reporting, we have recognition. Recognition. When we are talking of recognition there, recognition is inclusion of the item of element of the financial statement in any of the financial statement. Inclusion or incorporation, recording an item in the financial statement. What we mean by recognition in the conceptual framework. Now, ladies and gentlemen, assuming you have been recognizing a particular item in the financial statement as expense, you have now decided to recognize it as well as asset. We should see that change as a change in accounting what? Accounting policy. Let me give you an instance. In CAMA 1990, we have preliminary expenses there. Preliminary expenses under CAMA 1990 is recognized as intangible asset. And that was the way we normally treat it in the past years. But with the introduction of International Financial Reporting Standard and the adoption of International Financial Reporting Standard in Nigeria, we are made to know under International Accounting Standard 38, intangible asset, that these preliminary expenses, we are having like startup cost, initial cost, preliminary expenses. We are told not to do what? Not to capitalize it under IAS 38. So what is said to be capitalized under what? Under CAMA. We are now told by International Accounting Standard 38 not to capitalize it. We are told to expense it. So any item that we have been expensing before, that we are now capitalizing, or any expenses that we have been capitalizing, that we are now expensing, in accordance with the provision of IFRS, that is a change in the recognition of what? Of the item. Now, ladies and gentlemen, under International Accounting Standard 2, we have measurement basis of the inventory. At the end of the reporting period, when you want to value inventory can be valued at what? Either FIFO or what? First in, first out, or weighted average. If you are using weighted average before, but you discover that using weighted average, that by the time you now change, if you now decide to change it to FIFO, changing from weighted average to FIFO, it's a change in accounting what? It's a change in accounting what? In the measurement. And we can see it as what? As what? Changes in accounting policy, because it is a measurement basis that has changed. Am I communicating? So when there is a change in the recognition of the item, when there is a change in the measurement basis, am I communicating? We should see it as what? As a change in accounting what? Accounting policy. Let us say, for instance, in accordance with the provision of International Accounting Standard 40, which is what? Investment property. We have two what? We have two subsequent recognition or the measurement there. We have cost model and we have fair value model. If you have been using cost model, you have now decided to change from cost model to what? To fair value model. You change the measurement basis. We should see such change as a change in what? In accounting policy. And last but not least, presentation. Now, in the past years, some people do not know what item they should see as depreciation, or where depreciation should be. If we should ask people now, where do we normally show depreciation? Many people will say depreciation should be shown in the income statement. Yeah. When I was involved in the conversion of some financial statement to IFRS compliant financial statement, I could see a lot of blunders that so many companies have done. Like some companies, the depreciation on plant and equipment they are using for manufacturing, they will still show such depreciation as part of admin overhead. The depreciation of factory building, they will still show it as part of admin overhead. It is very wrong. Ladies and gentlemen, all these depreciation that are meant for the production of items, factory depreciation of factory building, depreciation of machinery should form part of the cost of goods sold, not part of admin overhead. When you're having delivery vehicle, the depreciation on delivery vehicle should be part of what? Distribution cost, not part of admin overhead, not part of what? Not part of cost of goods sold. So the purpose at which a particular asset is being used for is going to dictate how the depreciation on it is going to be dealt with. Depreciation can be part of cost of sales, it can be part of distribution cost, it can be part of admin expenses. Let's now imagine a situation whereby the depreciation that you're supposed to have recognized as part of distribution cost, you are now recognizing it as part of cost of goods sold. By the time you are now changing it to what? To where it's supposed to belong, that we can see that change as what? A change in accounting what? Accounting policy. So when there is a change in the recognition, measurement, and presentation, we should see such change as a change in what? In accounting policy. Now, after this, we have selection of accounting policy. Who has the duty to select the accounting policy? Well, it is the duty of the management to select the accounting policy. And when we are talking of selection of the accounting policy, we have it under International Accounting Standard 8 is that there are so many international financial reporting standards that deal with how a particular item is going to be dealt with. Like when you are having inventory, management does not have anything to do other than just to choose to do what? To follow inventory at lower at the report end of the every reporting period at lower of cost and net realizable value. The policy is already there. When you have property, plant, and equipment, management has no issue at all. We have International Accounting Standard 16 there for them. International Accounting Standard 16, cost model or what? Or revaluation model. Either of the model can be selected by the what? By the management of the reporting entity. Are we okay? If you are having investment property, IAS 40 is there. Financial instrument, IAS on financial instrument, IAS 32, IAS 39, IFRS 9 is also there. If you're having biological asset, IAS 41 is there, and so on and so forth. All these are what the management can rely on to do what? To select the accounting policy. And mind you, any accounting policy that is selected by the reporting entity should be applied consistently. But in a situation where there is no standard or interpretation, which specifically applies to the item, management, that is when the management is now having a duty to perform. The duty that management is now going to perform is to use their judgment to do what? In selecting an accounting policy that results in information that is relevant and will provide a faithful representation of the situation. So where there is no particular word, international standard or interpretation that applies specifically to a particular item, it has now become the duty and the responsibility of the management to select those accounting policies that they find to be what? They find to be reliable and what? And faithful, and provides a faithful representation of the item in the financial statement. But by the time they want to make this particular judgment, they might have to make reference to the requirement and guidance in International Accounting Standard Board and the interpretation dealing with the similar and related issue. Number two, the definition, recognition, criteria, measurement concept, and what? Of asset, liability, income, and expenses, as we have in the conceptual framework of ISB. Another one, the most recent pronouncement of other standard setting body that use a similar conceptual framework to develop accounting standard. They can make reference to other accounting literature and they can do what is applicable in the industry, accepted industry practice. These are all what they can make reference to when they want to select those accounting policies that will be relevant and reliable in a situation whereby there is no particular standard or interpretation that specifically applies to the item under consideration. So this is very important. Now, ladies and gentlemen, this accounting for changes in accounting policy. When there is a change in accounting policy, how are we going to account for it? Now, here we have mandatory change and we have voluntary change. Now, there are two reasons that can make us to change our accounting policy. Which one of the two reasons is mandatory? Which one is voluntary? The other time, I said that when there is a change in accounting policy that is required by a new word, by a new IFRS or its interpretation, we should see that as mandatory change. Mandatory change. Mandatory change, that is new IFRS or interpretation. That is a mandatory change. This is mandatory change. When the change is necessitated as a result of the new international financial reporting standard or what? Or interpretation, we call it mandatory change. Now, ladies and gentlemen, when new international financial reporting standard has been developed by International Accounting Standard Board, there will be what? Transitional provision. Transitional provision. Now, when you are changing accounting policy as a result of new IFRS or interpretation, if that new international financial reporting standard or interpretation comes with transitional provision. So, well, transitional provision is kind of a guideline that will come with that international financial reporting standard on the way in which such item could be dealt with. We call it what? Transitional provision. So if we have that transitional provision as additional what? Additional explanation on how we are going to deal with that item, we apply that transitional provision. In the absence of the what? Or in the absence of the transitional provision. In the absence of the transitional provision, well, that change in accounting policy is going to be adjusted for retrospectively. Retrospective application. It's going to be adjusted for retrospectively. So that's why we'll be talking of what? Retrospective application. Now, what do we mean by retrospective application? Well, retrospective application is the what? The application of that new what? New policy as if it has been in existence before. Any component, the application of that new word, the changes in the word, changes in accounting policy, as if we have been applying it before. Where do we make this word? Retrospective application. We make this change in the statement of changes in what? In equity. We make this change in the statement of what? Changes in equity. So that is where we make retrospective application of the new word, of changes in the word, in the policy. I'm going to demonstrate it, any moment now. Now, ladies and gentlemen, beside this one, for the voluntary change, what do we mean by voluntary change? When it is the belief of the management that when they change the accounting policy, the financial statement is going to be more relevant and what? And what? Faithful represented the situation we are talking of what? Voluntary change. When the financial statement will be what? Will be more relevant and what? Faithful representation. That is voluntary change. That is voluntary change. Now, ladies and gentlemen, so with this voluntary change, when we want to account for the voluntary change, we have it under International Accounting Standard A that it should be accounted for retrospectively. And that is it. So that is why many people will just be telling you that, well, when you want to account for a change in accounting policy, adjust for it retrospectively. It is not so. If it is what? A mandatory change, you can only adjust for it retrospectively where it does not come with what? Transitional provision. Where there is transitional provision, a kind of guideline on how that particular item is going to be dealt with. It is the transitional provision you are going to use, not retrospective application. You can only use transitional provision where you can only use what? Retrospective application where there is no transitional provision with the new IFRS requirement or its interpretation. So note this very well. Now, ladies and gentlemen, when there is now a change in accounting policy, what are we going to disclose? The title of the International Financial Reporting Standard. If the change is a sort of new IFRS or what? Or interpretation, we need to give the title of that IFRS or the title of the interpretation. Another one, the nature of what, I mean, reason for relevant, okay, nature of the change, adjustment made to the item affected. So in the word, I told you that the adjustment is going to be made in the statement of changes in liquidity. Any component of change, statement of changes in liquidity that must be affected, we need to be adjusted for. I'm going to demonstrate that any moment now. If the change is a voluntary change, we must give the reason why the financial statement is going to be relevant and what, and reliable or faithful representation of the situation if it's as a result of voluntary change. And we must show the nature of the change. Adjustment made to the item in the statement of changes in equity, we have to show it. And at the same time, if there is impracticability of the retrospective application, where the retrospective application cannot be applied, that's a limitation. We need to do what? We need to disclose such information in the financial statement as well. And that is the end of what? Of this word, changes in accounting policy. So the next thing is now to move to what? Changes in accounting estimate. I will be explaining both changes in accounting policy and what? And correction of error in the using what? Using statement of changes in equity as an instance later. Now, ladies and gentlemen, we move to what? Okay, beside that, we have changes in accounting estimate. Changes in accounting estimate. Now, ladies and gentlemen, what do we mean by changes in accounting estimate? Well, when there is a adjustment in the carrying amount of assets or liability as a result of the new information that is available to us, we should see that adjustment as a change in what? In accounting estimate. So an adjustment of the carrying amount of asset or liability or related expense resulting from the assessing the expected future benefit and obligation associated with that asset or liability. As more updates to up-to-date information becomes available, estimates should be refined to reflect this new information. So the effect of a change in accounting estimate should therefore be recognized for prospectively. Now, when there is a change in accounting estimate, now, ladies and gentlemen, there are various situations where we make estimates. When you acquire property, plant, and equipment, now tangible property, plant, and equipment, when you acquire each, you can say that you want to depreciate it over 5 years. That depreciation is what? Is an estimate. You can say that, well, its lifespan is going to be what? Is going to be this. It's an estimate. Are you getting me? Now, ladies and gentlemen, you use the asset for 2 years. You now, maybe the asset suffer impairment, and you discover that the asset that you have projected that is going to spend 5 years, after the end of the 2 years, due to the impairment that it has suffered, it cannot span for more than 2 years again. You now revise its lifespan to 2 years. It's a change in accounting estimate. So provision for warranty, a change in accounting estimate. In the inventories you have valued, you count your inventory, or you now discover that some of the inventory have become obsolete. Some of the inventory, they have lost their value, and you decide to write down the value of the inventory. That's a change in accounting estimate. Are we okay? We have various situations whereby we make changes in accounting estimate like that. Now, ladies and gentlemen, when there is a change in accounting estimate, how do we account for changes in accounting estimate? It is stated under International Accounting Standard 8 that a change in accounting estimate is going to be accounted for, retrospective and prospectively. What do we mean by what? Prospective adjustment. What we mean by prospective adjustment is that a change in accounting estimate is going to be adjusted for in the year in which it occurs. A change in accounting estimate will be adjusted for in the year in which that change occurs. And at the same time, if a change is a kind of a change that is going to affect the future period, it will be adjusted for in the year in which the change occurs, and at the same time, it will be adjusted for in the what? In the future period. And that is what we mean by what? And prospective adjustment. Now, when we say prospective, prospective adjustment under International Accounting Standard 8, as far as accounting estimate is concerned, what it simply means is that adjust
Some have started muting themselves now. Please, let's mute ourselves. Otherwise, I will mute all. Or let me even meet everyone. Then Mr. Ayuba can mute himself and continue. Okay. I think somebody has stopped that now.
Now listen.
So, Mr. Ayuba, please unmute yourself now so that you can continue. You are using 2 devices, right?
Yes.
No
Now, the
wonder I
adjustment is going
just
to
got
be,
it now. So
I'm
one
using
is
one to
for
present and making it from
sharing.
one to write.
Okay. I've seen it now. Yeah. Continue, sir.
Okay. Now, the prospective adjustment will be made in the current year if the item is only going to be what? If it has to do with the current year alone. But in the situation whereby the future period is going to be affected, prospective adjustment will be adjusted for in both current year and what? And future period. Let us say, for instance, we are going to see a question to demonstrate that. So, as far as changes in accounting estimate is concerned, it is what? Prospective adjustment. What are those things we are going to disclose when there is a change in accounting estimate? Well, the nature of the change and the amount of a change in the accounting estimate, which has an effect in the current period or have an effect in both the current and future period. So, ladies and gentlemen, that is the end of what? Changes in accounting estimate. The next one under International Accounting Standard 8 is error. So error is human. Error is human. We are prone to make mistakes. Nobody is an island of knowledge. We can make mistakes. It is only God that is invaluable. Mistakes can be made in any time. Unintentional error made. Are we okay? Now, what is error? Omission from the misstatement in an entity's financial statement for one or more period arising from a failure to use is either you fail to use or you misuse of reliable information that was available to you and could not be reasonably to have been obtained and taken into account in preparing those statements. Such error can result from mathematical mistake. Through the calculation, you are summing up, you are deducting, you are multiplying, you are dividing, error can be made. Mistakes in applying accounting policies. You might misapply accounting policies. A kind of error you have made in the past years may be oversight, or it might be misinterpretation of facts, or it may be an intentional one, fraud. Are we okay? When all of these things occur, we can see them as errors. Ladies and gentlemen, how do we account for a change in what? In prior error. When there is prior error, how do we account for it? In accordance with the provision of International Accounting Standard 8. It is stated, for a change in accounting policy. A change in accounting policy. We are talking of retrospective application. If it is error, it is retrospective. But we don't call it retrospective application. We call it retrospective restatement or retrospective adjustment. We don't call it application. We apply accounting policy, we adjust error. Am I communicating? We apply accounting policy. That's why we talk of retrospective application.
Yes.
But we don't apply
Let
error.
those that
We adjust error.
on their microphone mute it, please.
Am I communicating? And the meaning of retrospective adjustment is almost the same thing with the retrospective application we have when there is a change in accounting policy. What retrospective adjustment is telling us is that, well, we are going to adjust. The adjustment is going to be carried out in the statement of changes in equity as if that error has never occurred. As if that error has never occurred. And any component of the equity that might have been affected in the prior year, the prior years, are you getting me? They are also going to be adjusted for the effect of that error. Are we okay? So that is what we mean by what? Retrospective adjustment under International Accounting Standard 8. As regards what? Correction of prior errors. As regards prior error. Retrospective adjustment for error, retrospective application for what? Accounting policy. Am I communicating? Now, ladies and gentlemen, what are the disclosure requirements? The disclosure requirement for what? For prior error is very similar to the disclosure requirement for a change in accounting policy. The nature of the prior error, the amount of the correction at the beginning of the earliest period presented, impracticability of the retrospective adjustment. And you need to know When there is retrospective adjustment or we have retrospective application, either we are having what changes in accounting policy or what prior error that we are going to make an adjustment for in the statement of changes in equity, ladies and gentlemen, if that change is going to affect income and expenses, definitely we must give disclosure requirement on earnings per share, basic earnings per share, and diluted earnings per share in accordance with the provision of International Accounting Standard 33. So, ladies and gentlemen, that is for that. You can now see this case study. Let's look at this case study together. Hello, everyone. I believe you are paying attention.
Yes,
Let's
yes,
look at
yes.
Yes, sir. Yes, sir.
On 1st of
Very
January
much so.
2005, Marwa Garden PLC purchased heavy duty equipment. What are you going to do? You debit your equipment account, your credit card book on that day. On the date of installation, it was estimated that the machine has a useful life of 10 years. A useful life of 10 years and a residual value of what? Of 40,000 naira. Now, ladies and gentlemen, useful life of 10 years, estimate. Residual value of 40,000, estimate. Are you following, Ayuba? Accordingly, the annual depreciation workout is what? 36,000 naira. On 1st of January 2009, after 4 years, of using the equipment, the board decided to review the useful life of the equipment and its residual value. Technical experts were consulted, like you, my people, because I can see you as professional in the field. We are only just trying to do what? To revise what we have done in the past years. Any one of you can be in my position. We are only cross-pollinating ideas. We are sharing views. Not that I know it better than you. Now, technical experts were consulted. According to them, the remaining useful life of the equipment at 1st of January 2009 was now 7 years. Now, ladies and gentlemen, you can see that the asset that they have used for 4 years, they now reassess it at the end of the 4 years. They now discover that it can still be used for additional what? 7 years. 4 plus 7, 11. Ladies and gentlemen, this is what we can see. This is as well as changes in accounting what? Estimate. Previously, the lifespan had been estimated to be what? To be 10 years. But with the revision they carry out at the end of the 4th year, after they have used the asset, they are now having additional 7 years to spend, making 1 year in addition to the 6 that it ought to have been used before it is disposed of. So this is a change in accounting estimates. Am I communicating? Now, ladies and gentlemen, require complete the revised annual depreciation for the year 2007 and future years. The year 2007 and future year, that is what? Prospective adjustment. That is prospective. Are we okay? Prospective. Are we okay? Now, ladies and gentlemen, what will it be now?
Yes.
Don't forget that the asset has been depreciated for 4 years. So we will be having cost, which is 400,000 naira, minus 36,000 naira annual depreciation times that 4 years. What does it give you? To know the carrying amount at the end of the 4 years. What is the carrying amount of that asset at the end of the 4 years? Somebody that has calculator with him or somebody?
56,000.
What is it?
256,000 naira.
256,000.
Yes.
Okay, 400 minus 256. 256 like okay, 256,000 is the carrying amount.
Yes.
Thank you. So this is the carrying amount at the end of the 4th year when the lifespan is reviewed. Ladies and gentlemen, ladies and gentlemen, 256,000 naira. You now say they have revised 2 things, lifespan and residual value. So you will now be having annual depreciation. Annual depreciation after the revision will now be 256,000 minus 46,000 naira divided by 7 years, which is the new lifespan. And what do you have?
30,000.
30,000.
30,000.
30,000.
Ladies and gentlemen, 30,000 naira is now going to be our what? Annual depreciation from 2009 and other future years. Are we okay? That is what? A change in accounting estimate. This is a change in accounting what? Estimate. Ladies and gentlemen, the next slide. Slide 10. I skip it the other time. Let's look at this together, and that's going to be the last thing under International Accounting Standard 8. Which of the following is a change in accounting policy as opposed to a change in estimation technique? Ladies and gentlemen, let's look at this together. An entity has previously capitalized interest incurred in connection with the construction of non-current assets. It now writes off interest incurred to the income statement. Listen, all of you. An entity has previously capitalized interest incurred in connection with the construction of a non-current asset. It now writes off interest income to the income statement. Can somebody tell me, is this a change in accounting estimate or a change in accounting policy? Somebody.
Change in accounting policy.
Why do you say it's a change in accounting policy? What has actually changed? Is it recognition, measurement, or presentation?
It's recognition.
Beautiful, beautiful, beautiful. You know, the person might have erroneously might have had a thought that maybe that interest is on what? Is a borrowing cost in accordance with the provision of International Accounting Standard 23. But eventually, he may discover that it might now discover that this is not on the borrowing cost. Are you getting me? So note it. A change in recognition. So why it's a change in recognition, we should see it as a change in accounting policy. The next one, an entity has previously depreciated vehicle using the reducing balance method at 40% per year. It now uses the straight line method over a period of 5 years. Ladies and gentlemen, can we see this as a change in accounting policy or a change in accounting estimate?
Change in accounting policy.
Policy.
Why do you say it's a change in accounting policy?
No, this is measurement.
Because they change their policy.
Ladies and gentlemen, listen attentively. This is one of the things that I am asking for you. It is specifically stated under International Accounting Standard 16 that when there is a change in the depreciation method, we should never see it as a change in what? In accounting policy. We are going to see it as a change in what? Accounting estimate. That is the requirement of IFRS that you cannot contend. Why it is because the amount that has been estimated as depreciation before, we change. So it's a change in estimate. So we should see a change in accounting in the depreciation method as a change in accounting policy. It is specifically stated under International Accounting Standard 16, like that. Am I talking? So why it was a change in policy? One, change in policy. That is for A.
Change in
For
estimate.
B, change in what? Change
Estimate.
in policy. Estimate. B is a change in estimate. C, an entity has previously shown certain overhead within cost of sales. It now shows those overhead within admin expenses. Is it a change in policy or estimate? And if it's a whatever you give it, it is what?
Policy.
Estimate.
Policy.
Policy. Very good. Change in policy. What has actually changed?
Recognition. The present recognition.
Presentation. You are wonderful people. You are wonderful people. Last but not least here, D. An entity has previously stated quoted investment, F, at current asset at replacement cost. It now states this investment at net realizable value. Estimate or policy?
Estimate.
Estimate or policy?
Estimate.
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 No,
This
is
is
it
a change
an entity of
in policy.
this policy?
It's a policy
What has actually
measurement.
changed is measurement.
Measurement.
Okay, measurement, yeah.
With D. D is policy.
How you get it? So if you want to know that a particular thing change, just check what has happened. Is it a change in estimate? And is it a change in policy? Is it a change in, and if a change is a policy, is it recognition? Is it presentation? Is it measurement? If it is one of the three, you should see it as a change in what? In accounting policy. Ladies and gentlemen, thank you.
Thank you
Thank
so
very
much.
much, sir.
Awesome.
At this point, I think we should let Alhaji Ayuba to have time to probably for Jumat, I don't know, or at least to rest for a while.
It is not yet time for
What
Jumat.
do you think about that?
It is not yet time for Jumat.
It's not time for Jumat.
Are we going to Jumat?
Okay, can we wrap up the next one?
Should be around.
Okay, can we wrap up that time period?
I will present the next two. Okay. I have that time.
Please do. Please quickly do so that our next person can come in. So those that have sent their question to the chat box, I've noted them. I put them together. I will bring it on board when it is time, so that we can have, smooth time to go through this session. There are more detail. There's no way around it that we need more time, but often time will never be enough. Just bear with us. Shall we continue, sir?
Yeah.
Okay. So I have about, let me see the number of questions I've put together. I have 5 questions already. Although some,
no problem.
About 2 of them are just comments, but I have 5 questions that I've put together from what people have sent. Any other question, please? Okay, I will take this one question as well. I just see another one now. Let me see if there's another question.
Event after the reporting period. Event after the reporting period.
Okay. So all questions, they are being noted and they will be appropriately attended to when the time comes. Or I send it to Alhaji Ayuba, they will forward the correct answer.
You can send them to me.
When we have time, we'll discuss it extensively.
My wife will assist me to write them down.
No, I will send. No, I copy it, I put it in Word file. I will just send as an attachment to you personally. Is that okay?
Okay, in the WhatsApp. Okay, no problem.
Yes. Yeah.
Now,
so let's run.
Event after the reporting period. In the next 15 minutes, we are going to be done with this accounting standard. Very small accounting standard and very interesting one. Now, ladies and gentlemen, before you might be hearing event after the balance sheet date, post-balance sheet event. With the revision of International Financial Reporting Standard, we don't talk of post-balance sheet event or event after the balance sheet date again. We talk of what? Reporting period. Reporting period. End of the reporting period. Reporting period. Reporting period is a whole year. End of that particular period is the last day of that financial year before we start the presentation. Because when you are hearing event after the reporting period, you might be thinking maybe that is the last day of the year. Reporting period is a whole year. Let's say, for instance, in Nigeria year, our fiscal year is from 1st of January to 31st of December. Reporting period of a typical company will be from 1st of January to 31st of December. While the end of the reporting period is 31st of December. Ladies and gentlemen, transactions are occurred within that particular period, a whole year. And that is what we are going to have in the income statement, in the statement, in the financial statement. Now, ladies and gentlemen, We have a whole year operation. There will be trial balance. There will be additional information. My question to you is this. When the financial year ends on 31st of December, can financial statement be ready on 1st of January? My awesome colleague, can financial statement be ready on 1st of January?
No.
No.
It cannot be ready.
No.
Practically
It
impossible.
Cannot be
It's
ready.
not possible.
No, it's not
A week
possible.
after that, can the financial statement be ready?
Practically impossible.
Can it be ready
No,
in a
sir.
week after that?
It cannot be ready.
It can be ready in a week after that.
The
It can be
question
ready.
again.
No.
It depends
This
on the
software
nature and
district
operation of
available.
the business. It depends on the volume of the transaction. We have small businesses
I
that have little transaction in a whole year. Within 3-4 days at the end of the reporting period, they will do what? They will finalize their financial statement. And at the same time, we are having big organizations that even when they are working on their financial statement in 2 months, they are yet to complete it. All companies are having 6 months window to make their returns to the appropriate regulatory authority. So within that window, financial statement must be ready. Now, ladies and gentlemen, when the financial statement cannot be ready at 31st of December, for instance, that is telling you that between that date and the date in which the financial statement is going to be what? Is going to be authorized for issue. We call that is the date that is within the scope of this international accounting standard. Now, ladies and gentlemen, agenda, introduction, objective, scope, adjusting and non-adjusting, proposed equity dividend and going concern, disclosure requirement. Now, ladies and gentlemen, what does international accounting standard 10 say about event after the reporting period? That's a big question for all of you, all of us to answer. What does it say? Well, what the international accounting standard 10 says about what it says about international, this one, event after the reporting period is that they are critical events that we need to look at very well to know whether there will be an adjustment we are going to make to some of those events, or to know whether that, okay, we are not making any adjustment to this event, but we must make appropriate disclosure requirements. You see that we make disclosure requirements for some of those events, or we make adjustment to the trial balance at 31st of December for those events. So that is for that. Now, financial statements should reflect the most up-to-date data about facts and events that occur by the end of the reporting period. It is sometimes difficult to establish whether an event happening after the end of the reporting period is new information about an existing event or a new event. Users should be informed of significant events occurring after the end of the reporting period, such as acquisition. The provision of such information will help users to understand the impact of future work, future results. So this is one of the accounting standards that we need when we want to finalize the preparation of the financial statement. Now let us see this chart. Now, ladies and gentlemen, before this chart, let's see this. Now, let us assume that this start of the period, let us say it is 1st of January 2020. End of the period will be 31st of December 2020. Financial statement, let's assume that the financial statements are authorized for issue on 30th April, 30th 4th, 2020. Now, ladies and gentlemen, you see this particular period, 31st, between 31st of December and what? And 30th April. This is the period that are within the scope of IAS 20. The events we are talking of must occur within this period. Those events we are talking of, those events must occur within 31st December and what? And 30th April. Are you getting? And those are the events that are within the scope of International Accounting Standard what? International Accounting Standard 10. Any event after this particular period, after this 38th what? 38th April, they are outside. Anything after this date, they are outside the scope of IAS 10. Outside the scope of IAS 10. Regardless of what that event might be, they are outside the scope. So The event that are within the scope of IFRS 10 is the event that occur between the end of the reporting period and the date in which a certain set of documents will be authorized as what? As financial statement. What do we mean by event after the reporting period? In accordance with the provision of International Accounting Standard 10, event after the reporting period can be defined as what? Those events, favorable or unfavorable, that occur within the what? The end of the reporting period at a date and a particular date in which certain set of documents will be authorized as financial statement by the director of the company or by those that are at the governance level. So those are the events, favorable or unfavorable, that occur between the end of the reporting period and a date in which certain set of documents will be authorized for issue by who? By the director of the company. Those are the what? The events after the reporting period. And those events after the reporting period can be classified into two. We have adjusting events. The first classification is adjusting events, while the second classification is what? Non-adjusting events. Adjusting event, non-adjusting event. When we are talking of adjusting events are those events that provide additional evidences of those events that occur at the end of the reporting period. So they are only giving us a kind of, they are triggering off what has happened in the past period. They are pointing to the event that has occurred in the past period. 31st of December, we can see it as a what? We can see it as a pivot date. While 34th of April, 38th of April, we can see it as what? As the what? The deadline. Am I communicating at all? So now, any event that has occurred within this particular period, that is now pointing to what has happened in the what? In the financial period that has just come to an end, we should see those events as what? Adjusting events. And when we see those events as adjusting events, what adjusting event means? The financial implication of a particular item to be recognized as adjusting event is that that particular item, we need to adjust whatever the trial balance we are having of for the effect of that event, for the effect of the event. Are we okay? But when we are talking of what? Of non-adjusting event. Non-adjusting event also occurs within this period. The non-adjusting effect, they are the indicative of those effects that occur after the end of the reporting period. Because of the fact that they do not point to what has happened in the end, the financial year that has just come to an end. They are new information entirely. They are new transaction entirely. Ladies and gentlemen, they are not going to be adjusted for. And that's why they call them non-adjusting events. And pursuant to materiality, they must be disclosed as a footnote to what? To the financial statement. So now going back to the slide that we skipped the other time. Does the event occur between the reporting date and authorized date? The answer can be no. If the answer is no, if it doesn't occur between the reporting date and authorization date, that is telling you that that particular event is outside the scope of International Accounting Standard Standard 10. If the answer is yes, another question will be asked. Does the event relate to a condition that existed at the end of the reporting period? The answer could be what? Could be yes in the flow. In the flow chart, it could be no. If the answer is yes in the flow chart, that tells you that it is adjusting what? Adjusting event. If the answer is no, that tells you that it is non-adjusting event. So if the answer is yes, this is an adjusting event and the financial statements will be adjusted as appropriate. But if the answer is no, and not, that will instigate another question. No, does the event mean that the management will have to liquidate the entity or cease trading? The answer can be yes, it can be no. If the answer is yes, that means that item will be what? If it is yes, that means we are coming back to the going concern. If the answer is no, the management will not liquidate. That means it is purely non-adjusting event, which must be disclosed as a footnote pursuant to materiality. Pursuant to materiality. If the answer is yes, that is the issue of a going concern that we are going to be handling later. So, ladies and gentlemen, that is for that. Effect after the reporting period are those effects, favorable and unfavorable, that occur between the end of the reporting period and the date when the financial statements are authorized for issue. Ladies and gentlemen, we have examples of adjusting events. Allowances or inventory losses and doubtful debts. amount receivable or amount receivable or receivable in respect of insurance claim, which have been negotiated at the reporting before the year comes to an end. They have entered into the negotiation of it. Settlement after the reporting date of a court case confirming a liability. Receipt of information after the reporting period indicating that an asset was impaired at the reporting date, not after. Bankruptcy of customer or sale of inventory lower than their cost. The determination after the reporting period of the cost of asset purchase or proceed before the reporting period. Right? Let's take, for instance, a particular asset is acquired. So when that asset is acquired, there is no officer in charge to do what? To give you the invoice price or the price of that particular asset. But because of the strong relationship that is existing between the buyer and the reporting entity, you just give the asset to him. Okay, there is no problem. You can take the asset. By the time the person in charge is around, we are going to tell you the price and you are going to pay for it. Let's not assume that by the time the person in charge is now around, it is after the end of the reporting period. So if the price of that particular asset is now determined after the end of the reporting period, that means the transaction has occurred in the past years. We are going to see it as what? As adjusting what? Adjusting event. So, ladies and gentlemen, we have examples of what? Of non-adjusting event. And you are going to see that the example of this non-adjusting event, they are something that has happened for the first time. They are occurring for the first time. Issue of new share or loan capital, purchase, disposal, or closure of a business, financial consequence of a fire or what? Or flood. Like when this was fire, flood disaster, Omiyale, when it occurs, are you getting me? In Oyo State, 2011. Are you getting me? Whatever must have been washed away with that particular disaster, we could see if it happens after the end of the reporting period. We have to see it as well. But before the financial statements are authorized for issue, it is a catastrophe. We should see something like that as non-adjusting event. Declaration of an equity dividend. Yeah, that's good. This is a significant change that we need to explain. Decline in the market value of an investment. It is specifically stated under International Accounting Standard 10 that after the end of the reporting period, when there is a decline in the market value of the investment, we should see such decline as well as non-adjusting event. Besides that, we have classification of assets as held for sales under that is International Financial Reporting Standard 5. Non-current asset held for sales and discontinued operation that occurs at the end of the reporting period, but before the financial statements are authorized for issue, should be classified as well, non-adjusting. Expropriation of assets. What do we mean by expropriation of assets? That is the confiscation, seizure of assets, seizing or confiscation of assets by those in power, by the government. When government seizes your asset, they confiscate your asset, your property. Are you getting after the end of the reporting period, but before the financial statements are authorized for issue, we should see it as non-adjusting. Any lawsuit that the business reporting entity commences after the end of the reporting period, but before the financial statements are authorized for issue, they are what? They should be treated, or that item should be treated as non-adjusting event. But we have to know something. If lawsuit has started right from the beginning, before the end of the financial year, it will be treated as what? Adjusting event. Now, ladies and gentlemen, that is for that. As far as the dividend and what? Going concern is concerned, for the dividend, I don't need to bother myself on this dividend. Any dividend that is proposed after the end of the reporting period, let us even assume that the end of the reporting period is 31st of December. 31st December 2022. If dividend is proposed on 1st of January 2023, it has become what? Non-adjusting event. It is non-adjusting event. Why you are still going to treat that dividend as non-adjusting event is because as at 31st of December 2022, reporting entity does not have any obligation to pay such dividend. Pursuant to materiality, any dividend proposed at the end of after the end of the reporting period is going to be disclosed as a footnote to the financial statement. We are now moving to the going concern concept. Now, ladies and gentlemen, if after the end of the reporting period, but before the financial statements are authorized for issue, the going concern of the business is under threat, it is stated under International Accounting Standard 10 that management will not prepare financial statement on a going concern basis. They are going to use another basis that is appropriate to prepare it. And that is the question. That basis is not stated under International Accounting Standard 10, but in practice, which basis is going to be appropriate? Going concern basis, liquidation basis. That is the basis upon which such financial statement is going to be what? Is going to be what? Prepared. If the going concern of the business is under threat after the end of the reporting period, but before the financial statements are authorized for issue. Ladies and gentlemen, the disclosure requirement under International Accounting Standard 10. Date when the financial statements were authorized for issue. The name of the director that has given that authorization. Name of the party, if any, with the power to amend financial statements after issuance. Nature of the event that has led to the word. Okay, estimate of the financial event. A statement if such estimate cannot be what? Cannot be made. Now that is for what? For non-adjusting event. This one are for non. The other three are for non-adjusting what? Adjusting event. What is the nature of that event? What is the estimate of his financial effect? What is a statement has to be made if such estimate cannot be made for non-adjusting what? Non-adjusting events. Non-adjusting events. Are we okay? These are the disclosures you are going to make on them. So, ladies and gentlemen, that is the end of this. But let's just look at this one case and end this one before we move to another accounting standard. Now, ladies and gentlemen, we are having some events here. We are going to determine whether they are adjusting event or what? Non-adjusting event. The first question here, my distinguished professional colleagues, are you with Ayuba?
Yes, sir.
Okay.
Yes, sir.
Yes,
Insolvency of a customer.
Everybody's.
With you.
Insolvency of a customer. Is it adjusting event or non-adjusting event?
Adjusting events.
Adjusting
No
event.
adjusting. Non-adjusting.
Non-adjusting.
Insolvency of a customer.
It's not adjusting.
It's non-adjusting.
Insolvency of a customer is adjusting event.
It is.
Because you cannot recover that debt.
The debt
Let
is
me
off.
explain it.
You have to. That's all.
You are having receivable.
Insolvency when?
You are having a receivable as part of your trial balance. But before the financial statements are authorized for issue, you get an information that they have declared your customer has been bankrupt. Ladies and gentlemen, whatever the amount that has been owed to you by that customer has to be written off. It is going to be treated as what?
Yes.
Adjusting.
Are you getting
it very well? It has to be written off. The amount, that amount, you cannot collect from your customer again. Are you getting me? The transaction is already in the financial statement since the year that has just come to an end. Receivable. Another one, loss of inventory due to a flood. Adjusting or non-adjusting?
Non-adjusting.
Non-adjusting.
Adjusting events.
It's not.
You see, it's not adjusting now. Very tricky.
Hello, adjusting.
Loss of inventory due to a flood.
Non-adjusting.
Non-adjusting.
Hello?
Can you guess it?
Loss of inventory due to a flood is non-adjusting event. Let me explain.
Non-adjusting. Yes.
Why is it
You are
non-adjusting
having
event?
your inventory at 31st of December. Are you getting me? If any fire should occur in February, or fire disaster should occur in February, or those inventories are carted away by thieves in February, and the financial statement has not been authorized for issue, we should not treat it as adjusting event. They are what? They are non-adjusting. Go and check the list of the non-adjusting that we have given. Now, ladies and gentlemen, completion of purchase of another company. When you purchase another company after the end of the reporting period, but before the financial year authorized for you, adjusting or non-adjusting?
Adjusting.
Non-adjusting.
Adjusting because you have started. Adjusting because you have started. I think it's adjusting because you have started the purchase in the course of the year.
Completion of the purchase of another company.
Oh, it's completion.
The completion shows, gives more information.
Adjusting.
The transaction that existed as
It's
Non-adjusting.
Hello.
still non-adjusting.
Hello.
I think it will be
It's not.
Hello.
To me, at
Hello.
least, no.
Hello, everyone. Can you hear me?
It will be
Hello.
adjusting.
Please don't let us make this thing rowdy. We are professional. I will suggest that anybody that has something to say, immediately the question is asked. Let's put it on the chat board. You raise up your hand and you can be given opportunity to to see it. Then the paper presenter will tell us right or wrong and give us the professional reason for it. Thank you.
Now, ladies and gentlemen, go to the example of non-adjusting. Check that number 2 there. Purchase, disposal, or closure of a business. Are you listening to me?
Yes.
Purchase, disposal, or closure of a business, not only of a business, of an asset as well. Hello, ladies and gentlemen, you can enter into a transaction before the end of the reporting period. If that transaction has not been finalized, the transaction is not yet to do what? Occur. If you place an order, are you getting me? And the order has not been what? And the order has not been supplied to you. Will you say that the transaction has occurred?
No.
We professional accountants.
According to
Are you going to say
IFRS,
that the transaction has occurred?
No.
no, it has not occurred.
So this transaction completion of the purchase of when you purchase another company in that particular period, the period in which the purchase is completed, that is when the consideration is going to be made, and that is exactly when we are going to say that the transaction has occurred. Are you getting me? So this particular one is what? Non-adjusting what? Event. Now, evidence showing that the net realizable value of inventory is below cost. Adjusting or non-adjusting?
Adjusting.
Adjusting.
Adjusting event.
Adjusting.
A court case from August. A court case from August is settled under C. Let us assume that this court case let's assume that the financial year of the company in question ends in December. They have started that court case in August. Are you getting me? But they now settle it after the end of the reporting period. Are we going to see it as adjusting or non-adjusting?
Adjusting.
Adjusting. Discovery of a fraud showing the financial statement were incorrect.
Adjusting.
Adjusting.
Fraud has occurred before the financial year comes to an end. You just got relevant information to discover that fraud. Are we okay? So, ladies and gentlemen,
Adjusting.
So, any other question we may still want to ask on this, by the time we get to the question and answer period, you can ask me and I'll be able to answer them. Ladies and gentlemen, thank you.
Thank you, sir.
Thank you, Alaji.
How are you?
We are rounding up to the last segment of this paper.
Can you hear me?
Thank you so much. All questions, please let's note all questions. They are noted. I need to mute some people. I don't know. Let me mute everybody now.
Last but not.
Okay. Please unmute yourself. Mr. Iba, unmute yourself, please.
Please, what time is tomorrow's session starting?
We start 10 a.m. as usual. Then I will send the online will be open by 9:30. Then I will send the link to our email. Immediately it is open. So it is that link everybody will use to access it. Then we'll communicate. I want everybody to join the WhatsApp group I just created so that I can make communication effective. Okay.
Okay.
Over to you, Mr. Iba.
Who is your number for WhatsApp? Hello?
Sorry, I forgot.
No, there's a WhatsApp group. I will post it again.
Are we getting the recording after the whole thing?
Every recording, certificate, everything, it will be downloadable from the platform you use to register.
How do we join the WhatsApp group now? How do we join the WhatsApp group?
I will send the link. I will send the link again now on the chat.
Okay.
All right. So, Mr. Iba, please let's go. Our next
interim financial reporting. This is another interesting.
How long are we going with this, sir? How long will it take us?
This one, I think I should finish this one in the next 10 minutes or 15 minutes at most.
Okay, that's fine. Thank you.
This is the last one, are you?
Interim financial reporting. Now, ladies and gentlemen,
no, the last one, we still have other, so we just relax for like 10 minutes. Yeah. Continue.
Now, ladies and gentlemen, by anything September this year, you are going to be seeing some financial statements in the daily news, national newspapers. They will bring out the result, the performance of what? Of the company over that, some months, 6 months specifically, in the daily news. But that particular information will not be circulated to the shareholders. The shareholder that wants to get that information can only get that information in the what? In the national newspaper. That's why they normally publish it in the national newspaper. Ladies and gentlemen, that is interim financial reporting. That is interim financial reporting. And that is exactly the accounting standard we want to present now. The learning objective, the objective and scope, key terms and content, determine the current and comparative interim period reporting, recognition and measurement criteria, type of estimates that are permitted, and the disclosure. Okay, and type of estimates that are permitted. There is no disclosure on this accounting standard. It's a disclosure accounting standard on its own. Now, ladies and gentlemen, objective and scope. So the objective of this international accounting standard is to prescribe minimum content that we will be having when we decide to prepare interim financial statement, and to explain what is going to be to prescribe the recognition and measurement basis of the item that particular financial statement is going to contain. And ladies and gentlemen, which entities are expected to do what? To prepare this statement. International Accounting Standard 34 does not require any entity to prepare this particular statement. Though we know that in practice, public companies, quoted companies, they prepare this financial statement. If it is not required by what? By International Accounting Standard, or by what? International Accounting Standard 34. If no particular entity is stated under IAS 34 that should be preparing, why are they now preparing it? Yes, it is something that is required by what? This what? It might be government, or alternatively, it may be required by what? The Stock Exchange, Security Exchange Commission. Are you getting me? Or elder regulators. Now, those are the ones that require it, but it is not required by what? By international, in the International Accounting Standard that a particular entity should prepare it. However, those entities that prepare it, they are what? They are public quoted entities. So, if the private entity decides to do what? To prepare it, that is voluntary. There is no compulsion for them to do what? To prepare it. But all these regulatory authorities that we are talking about, like STEC or whatever, they can do what? They can do what? They can, require the company to do what? To prepare the financial statement. Now, ladies and gentlemen, what is the frequency of reporting? Well, the frequency of reporting this particular financial statement is not particularly stated. Well, we have it that it can be prepared on quarterly basis. It can be prepared on what? Twice in a year. But ladies and gentlemen, in what? Republic of Ireland, UK, Nigeria, we prepare it on what? Half yearly. While in other clients like US, they prepare it on quarterly basis. That is the frequency of reporting. And what is the what is the practice in other clients? The standard. What is the standard of International Accounting Standard Board? Well, the standard of the International Accounting Standard Board is that they encourage any entities that want to prepare this interim financial reporting to prepare it in accordance with the provision of International Accounting Standard 34. Is there any deadline that financial statement can be prepared? Yes, we have the deadline. Let's assume that the financial year of the company is what? Is 31st of December. Half year of that company is going to be 30th of June. If 30th of June is the half year, all companies are expected to do what? To prepare, if they want to prepare it, they are expected to complete the preparation within 60 days. That means by 31st of what? 31st of August. Any company that wants to prepare this interim financial statement in accordance with the provision of what? International Accounting Standard 34 have completed is what? Is preparation within 60 days. 60 days. That is the time limit within which it should be what? You should be prepared. Am I okay? So don't forget that the frequency of the reporting can either be what? Quarterly.
Somebody is. Somebody microphone is on, please.
We can as well be what?
Hey, Alaji, I meet everyone, so you can meet yourself now. Mr. Iba, you can meet yourself now. No, there are a lot of background noise, so I mute everyone. So he will mute himself now. You can go ahead. You have the floor.
Okay, thank you. Yeah. What is now interim financial statement? An interim financial report is defined as being a financial report containing either a complete set of financial statement that is prepared in accordance with the provision of International Accounting Standard 1, or a condensed set of the financial statement for an interim period that is prepared in accordance with the provision of International Accounting Standard 34. If it is a complete set that you want to have in your interim financial statement, it will be prepared in accordance with the provision of IAS 1. If it's a condensed set of financial statement you want to have as a component of your financial statement in the interim period, it is going to be prepared in accordance with the provision of IAS 34. And what is the interim period? An interim period is any financial reporting period which is shorter than a full financial year. That's why we have said it can be prepared on a quarterly basis or half-yearly basis. Quarterly basis or what? Half-yearly what? Yearly basis. They are shorter than what? They should be shorter than a whole year. So any financial statement that is a period that is shorter than a whole year, we can see it as what? As interim period. Now, ladies and gentlemen, forms and content. Now, ladies and gentlemen, as far as interim financial statement is concerned, it could be prepared, it could be a complete set of the financial statement. If it's a complete set of the financial statement, that means all the 5 components of the financial statement that we have discussed under International Accounting Standard 1 will be there. However, if it's a condensed set, these are the 5 statements we are going to have under the condensed set. Condensed statement of financial position, condensed statement of profit or loss, condensed statement of changes in equity, condensed statement of cash flow, and selected explanatory note if it is condensed statement. What do we mean by condensed statement? Condensed statement means that each of the headings and subtotal presented in the entity's most recent annual financial statement is required, but there is no requirement to include greater detail unless this is specifically stated by what? International Accounting Standard 34. So what we mean by condensed is that. Now, ladies and gentlemen, reporting period. Interim period report should include interim financial statement, condensed or complete for period as follows. For the statement of financial position at the end of the current interim period, at the end of the immediate preceding financial year, if we are going to see another illustration of this, that one is going to be for a whole year for the statement of financial position. For the statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flow, they are going to cover a period of what? 6 months, whether at the current period or in the what? The comparative data, a period of 6 months. Now, ladies and gentlemen, like we have an illustration to that here. Reporting period for interim financial statement, e.g. Premium PLC financial year end, 31st July 2003, publishes half-yearly financial reporting. First set for financial year 2003 will be for 6 months. That is 1st of January to what? 30th of June. So as far as the statement of financial position is concerned, at 30th of June 2023, while the comparative data is going to be for 30th December 2022. Okay, statement of comprehensive income 6 months ending 30th of June 2023 6 months ending 30th of June 2022. Statement of changes in equity 6 months ending 30th of June 2023, 6 months ending 30th of June 2022 as comparative data information for that. And statement of changes in equity 6 months ending 30th of June 2023 and 6 months ending 30th of June 2022. It is only the statement of financial position that is going to cover a whole period, a whole year, while other ones will cover a period of what? A period of 6 months. Now, ladies and gentlemen, these are the selected explanatory notes, accounting policy and method. Well, the accounting policy that must be adopted in the preparation and what? There must be a note, explanatory note on the accounting policy that has been adopted. The accounting policy that is adopted for the preparation of the main financial statement of the business should be used to prepare interim financial statement. Should there be any change in that accounting policy, it has to be stated. We may have some business that their operation may be seasonal. The information of the statement has to be given as to whether the operation of the business during the interim period is cyclical or seasonal. Nature and amount of change in any estimate that has been made. Are we okay? In the interim period, it has to be what? It has to be given. Issue purchase and purchase of debt and equity. There may be new issue of shares, there might be new purchase of shares, there might be repayment of debt. Are you getting me? During the what? During the interim period, the note has to be given on that. The statement must, explanatory note must be given. Any dividend paid, that is going to be the interim dividend. If the business pays any interim dividend during the interim period, there must be disclosure, there must be explanatory note on it. Certain segment information in accordance with international financial reporting standard, it has to be given. Event after the interim period, like we have event after the reporting period. Any event after the interim period that is going to affect the balances we are having at the interim period is also going to be given. Changes in the group structure. When we are talking of changes in the group structure in accordance with international financial reporting standard 3, that change can be disposal of subsidiary, it might be addition to subsidiary, step acquisition. All these, if we have them, it has to be given as part of selected explanatory note. And last but not least, under the note, change in the contingent asset and what? And contingent liabilities. All these are part of the explanatory note that must be given in the what? In the interim period. Now, recognition and measurement. As far as the preparation of the statement of what? That means this what? Interim financial statement is concerned, we have two approaches that can be adopted. We have integral approaches and we have district approaches. When we are talking of district approaches, the interim financial statement is going to be seen as an independent, a standalone financial statement on its own. A standalone, which is independent on its own. Whatever we are having right from the beginning of the period to that half year, that is exactly what we are going to report. No adjustment to it. But if we see it as what? If we see it as an integral part, that means the financial information for a whole year can be prorated. It's going to be an estimate, going to be based on the what? On the whole year. That is if we see it as integral, if we want to use integral approach. Well, for the district approach, where each item period stands as, each interim period stands as an independent reporting period. Integral approach, each interim period is as part of the larger accounting year to which belong. Where revenue and cost will be recognized as a proportion of the annual total. So, ladies and gentlemen, the approach that is adopted under International Accounting Standard 34 is district approach, where the interim period stands alone as an independent reporting period. Ladies and gentlemen, uses of estimate. For the uses of estimate under International Accounting Standard 34, you will discover that we have inventory. At the end of every reporting period, inventory has to be valued. Do we need to value inventory at the end for what? For the purpose of interim financial period? Well, it should be this one should be based on what? On estimate. We don't need to value contingencies in accordance with and provision in accordance with International Accounting Standard 37. We may need an expert to calculate the amount of contingency that we are going to be, the business is going to be involved in. Expert is not going to be needed for the interim financial period. Whatever the estimate we have in the prior period, that estimate we can rely on it to determine what we are going to have in the interim financial statement. The same thing is applicable to the provision. We may need the work of the expert as far as the provision is concerned. Under when we are preparing the normal the financial statement. We don't need all these when it comes to the interim financial statement, because doing that may be too demanding. So, ladies and gentlemen, so that is for that. Thank you for being wonderful listeners. I appreciate all of you.
Thank you so much. Thank you for
Thank you, sir.
working within the time frame. Everybody really appreciate you. But I think if not because we had technical issues when we started, of course, protocol required that I should read fully the profile of the paper presenter. So just permit me within the next 2-3 minutes to do so, while the next paper presenter will be getting set, then we attend to the few questions that have been sent. So without missing word, everybody acknowledge that this session, although very voluminous, but so enriching and very, very interactive. Permit me, ladies and gentlemen, to quickly give us the brief profile of somebody that has been with us since 4 hours ago. We started exactly 3 hours, 50 minutes ago. So I'll quickly do that while this paper presenter getting set. Then the attention will be given to some questions that have been set. Mr. Ayuba Kodri Olayemi is a fellow of our institute and also a member of ACCA, United Kingdom. And he's also an associate member of Institute of Professional Managers, which is in United Kingdom. He holds higher national diploma in accountancy at upper grade level from the Polytechnic Ibadan in Oyo State. He has over 24 of quality experience spanning across taxation, accounting, feasibility study, financial management, consultancy in manufacturing company, banking sector, insurance sector, oil and gas related company. He has contributed immensely to the human capital development in the area of accounting and finance, and has 2,500 qualified chartered accountants. He is a prolific and seasoned resource person on international financial reporting standards. And I believe everyone at this forum this morning, afternoon, can bear witness to this attestation. Our paper presenter has handled contemporary issue in strategic management, risk management, managerial finance, accounting. He is the immediate past chairman for Ibadan District Society of ICANN and is the current chairman of audit committee for both Guinea Insurance PLC and University Press. I believe we understand for somebody to be an audit committee, one of the strongest committee in a quoted company is an audit committee of which our paper presenter is a chairman of this committee. He also the chairman and CEO of Financial Training Hub, the center that produced the youngest qualified accountant in Africa, and a lead consultant in Pure Integrity Consults. By the grace of God, Mr. Ayuba, a trainer of trainers, yes, no doubt about that. He's happily married to a chartered accountant and as a chartered accountant as one of his children. So Mr. Ayuba has given another generation of chartered accountants that will take up and do more than what he's doing currently by the grace of God. So, ladies and gentlemen, that's just the brief profile of our paper presenter who has been with us since almost 4 hours ago. Alhaji Kodri Olayemi Ayuba. Thank you once again for being here. I'll quickly send Alhaji Ayuba. So I will copy this question to your WhatsApp group now. Can you access it?
Yes.
Will you be able to access it? Okay.
I will.
Copy it now. There are about 10 questions, but some of them they are related. So I want you to quickly attend to them briefly. Then while the next paper presenter is getting set for us. Just 1 minute. I'll send it now. Okay. Yeah, it's been sent.
Okay, I've received that. The first question.
It's sent.
Can you listen? Can you hear me?
Will you die? Okay, okay, we can hear you. Go ahead.
Within the other comprehensive income, kindly explain the distinction between the item that will be classified to the income statement and the item that will not be reclassified to the income statement. That's number one. Thank you. Now, those items that we will not reclassify to the income statement are these. We don't reclassify revaluation stop loss to the income statement. We don't reclassify foreign exchange gain or loss to the income statement. We do not reclassify actuarial gain or loss in accordance with the provision of International Accounting Standard 19 to the income statement. But the other two can be reclassified to the income statement. That is fair value gain or loss on what? On available for sales financial asset, together with the fair value gain or loss on what? On that cash flow edge. The two can be reclassified. But the first three I have mentioned, they cannot be reclassified to the income statement. That is the answer to that. The next one, what is the position of bad debt written off under cash flow statement presentation? Thank you very much. Now, you see, when we say bad debt written off is something that must have been deducted from the debtor. It is already deducted from the debtor. So, bad debt written off has no place when you are preparing statement of cash flow because it has been removed from the debtors. And it is the debtors balance that we are comparing with each other when we are preparing statement of what? Of cash flow. Therefore, that bad debt is already embedded in the what? In the receivable, the balance of the two receivables. Because what we normally have in the statement of financial position is after we have deducted the bad debt. So definitely we have automatically taken care of the bad debt as we are comparing the two balances of the receivable with each other. Question number 3. My question is, for instance, this is an investment in 2022 financial statement where there is an additional investment in 2023.
Please let's mute our microphone. Some people microphone is on. Can you please mute it, please, so that we can smooth something? Okay, let me meet everyone. Then Alaji can unmute himself. So please unmute yourself and go on.
Okay, thank you. Question number 3. My question is, for instance, there is an investment in 2022. Investment in 2022. The financial statement. Why there is an additional investment in 2023? Very good. 2022, 2023. Let's assume that we have 150 here, we have 190 here. Investment. That is exactly what you have put here. We will be having increase or decrease, or we will recognize the total amount in the cash flow in the current year. Now, when you are preparing statement of cash flow, this particular investment, if it is not cash equivalent, if it is long-term investment, what you are going to have in the statement of cash flow as what? Cost of acquiring investment will be 190,000 minus 150, which is 40. It is the change you are going to have. Change in the cash flow, 40 that you are going to have, not 190. You can't have everything. How will you treat revaluation in cash flow? Thank you for that brilliant question. When you are preparing statement of cash flows, we have some items that are non-cash items. Non-cash items should not be reflected in the statement of cash flow. So when you have a revaluation surplus or deficit in the statement of cash flow, they have to be removed so as to not to distort the information we have. Let us say, for instance, you have your property, plant, and equipment like this. Your balance brought forward is this, and your balance carried down is this. If there is a revaluation surplus, Now, let me use figures so that you get it clearly. Assuming you have balance brought forward of 50, you have balance carried down of 90. And let's say there is a disposal during the year, disposal. Let's say it is 10. If you say 10, let's assume that there is revaluation surplus of 15 during the year. So if you say 10 plus 90, 10 plus 90 will be giving you 100. 100 plus 50, that is 50. That is difference, cash. And you will be tempted to take this cash of 50 to the statement of cash flows. If you are taking 50 to the statement of cash flow, if you are taking 50 to the statement of cash flow, you have committed a blunder. Because you do not take cognizance of the fact that there is a revaluation of assets. So you can't take 50 to the statement of cash flow. Rather than to take 50 to the statement of cash flow, you must recognize the revaluation surplus that has occurred. So revaluation surplus, 15. So that 35 is the actual amount of cash that you have spent on the acquisition of the assets during the year. And if it is revaluation deficit, it has to be credited. So revaluation surplus is a non-cash item and it does not have any place in the preparation of the statement of cash flows. Are we okay? The next question. Yeah. Question number 4. I mean, that is question number 4. Okay, yes. Question number 5. My question is, can we say that as at today, all organizations in Nigeria are reporting their financial statement using international financial reporting standard? Well, let me tell you, it is mandated for all quoted companies that they must have adopted international financial reporting standard as at the time I'm making this presentation. If you have any company that has not adopted international financial reporting standard as at the date I'm making this presentation, our Financial Reporting Council of Nigeria is going to penalize such company. Private company can be exempted, but if it is publicly quoted company, by now they must, even private company, they are now mandating it for private companies to have adopted international financial reporting standard. So if you have any company that has not adopted international financial reporting standard, Financial Reporting Council of Nigeria can subject that type of company to what? To penalty. So that is for that. Another one, question number 6. Please, how does an accountant work in an entity where financial statements are yet to be presented according to what international financial reporting standard? How does an accountant work as a full professional? Well, as a professional, being a professional is more than just knowing the debit and credit entry. Being a professional is more than being able to prepare financial statements. Being a professional is more than having the knowledge of taxation. But we are advisors, business advisors. If you are operating an entity,
please unmute yourself, Alaji. I need to put some people on note. Unmute yourself and go on. We have too much people. People couldn't control themselves. We said, if you are not speaking, why are you putting your microphone on? You are distracting others. So, Alaji Quadri, yeah, Ayuba. Alaji Ayuba, are you still there?
I'm there. A professional accountant should be a good advisor to an organization where he's working. If you are working in an environment where they have not adopted international financial reporting standard, as a professional in the field, you should be able to give a constructive advice that they should adopt IFRS, and you let them realize the benefits that will accrue to them when they adopt the use of what? International financial reporting standard for the preparation and presentation of their financial statement. Another one, is there any policy that says a building in use may not be depreciated? Now, ladies and gentlemen, a building in use, there is no policy that has stated that any building in use may not be depreciated. But the issue is just this. We know that to depreciate building, ordinarily in the profession, we know that building should be depreciated over 50 years at most. Over 50 years at most. If a particular building lifespan has been exhausted, are you getting me? and we are still having that particular building in the financial statement, what we should do as a professional is that is why there is a revision of what? There is a revision of, at the end of every reporting period. We have that revision under International Accounting Standard 16 as well. We should be revising what? The value of our building or the value of our property, plant, and equipment. There may be adjustment in the lifespan. If you know that the building can still have what? Can still produce more to the reporting entity, can still bring more future economic benefit to the reporting entity. Its lifespan can be revised. If its lifespan is revised, we will be subjected to a depreciation. But if the particular lifespan of the asset has been exhausted and they do not revise, they don't adjust the lifespan, that is why we can be keeping it in the book without subjecting it to annual depreciation again. But they are not going to remove it so far it is still generating future economic benefit. And something like that is what is applicable under taxation, that after the building must have been subjected to capital allowance and it has got to the last year, it will be stated that you must retain 10 naira for each asset. So if 10 naira is now retained, that 10 naira that is retained here, though that one is for the purpose of taxation, that is just to prevent oversighting. That is just to prevent that, okay, this particular asset is still existing, because if that 10 is not retained in the book, it might be forgotten by the time it is disposed of. Are we okay? So that is why it is there. So no particular policy says that assets should not be depreciated. Asset is expected to be depreciated, even if it has got to the end of its useful lifespan. If it is still useful to the reporting entity, you can still revise its lifespan so that you continue to subject it to annual depreciation, because any part of the asset that is used in a year must be recognized in the income statement, and that is what matching concept is telling us. That is what matching concept is telling us. So number 8, under IAS 1, you are talking about how statement of profit or loss and all comprehensive income can be prepared as a single and two-step statement. Very good of you. Single statement or two-step statement. Let me share the screen to explain that. Single statement or two-step statement. I will share my screen to explain that right now. Okay, give me 1 minute to quickly do that. As a single statement, when you prepare your statement of profit or loss, you have revenue, cost of sales, gross profit, all our figures. You have distribution costs, admin expenses, all our figures. You get it up to profit for the year. Are we okay? Let's say that this profit for the year, let us assume that it is 50 naira. Keep it simple. AIS, keys. Keep it simple. Even if it is to a stupid, it will be kept simple. Now, ladies and gentlemen, profit for the year 50. Other comprehensive income. Revaluation surplus. Fair value gain. On what? On available for sales financial asset. Let's say we have 2 naira here, 3 naira here. 50 plus 5, that gives us 55. Total what? Total comprehensive income. This is a single statement of income statement in accordance with the provision of International Accounting Standard 1. But that is a one-step statement. But if you want to prepare it 2-step, you have your this. Immediately you have your profit for the year. You close it. Profit for the year. You now prepare statement of other comprehensive income for the year what ended as a standalone statement on its own. You now start it with what? Profit for the year, 50 other comprehensive income. Revaluation so and so. 2, 3 total comprehensive income. So statement of other comprehensive income will be a statement. Statement of profit or loss is going to be another statement. That is the 2-step. But if you prepare everything together, that is one step to answer that. Is it clear? The next one. What is the treatment of reduction in the estimated year of an asset? Reduction in the estimated year of an asset. Okay. When we are talking of the reduction in the estimated year of an asset, that we can see this one as well. Changes in accounting estimate. Let's assume that the lifespan of asset is 6 years before. But due to one reason or another, it has been reduced to 4. After you have used that asset for, say, 2 years, you discover that that asset cannot function well again. His effectiveness, his productivity has fallen down. If his productivity has drastically reduced, and you discover that it cannot span for more than 2 years again, that means whatever you are having as the carrying amount at the end of the 2 years is going to be spread over the balance of the rest 2 years. We will still see this one under International Accounting Standard 8 as changes in accounting work, changes in accounting estimates. Are we okay? Because it is the lifespan that has changed, which is an estimate. Last but not least, it will categorize an insolvency of a customer as an adjusting event. Then please, how about if such customer was confirmed solvent at the reporting date of the reporting entity and declare insolvent at a day after the reporting period of what? Of the reporting entity. How do we categorize such event? It is still adjusting event. If an insolvency of as an adjusting event, then please, how if such customer was confirmed solvent at the reporting date? A customer that has been confirmed as solvent at the reporting date, definitely after the reporting date, it at solvent at the reporting date. Definitely after the reporting date. If that after the reporting date is between what? The end of the reporting period and the date in which the financial statement is going to be authorized for issue, we should still see it as what? As adjusting event. And note, any item that we do not treat as adjusting event, that we are now categorizing as non-adjusting event, it is not that we are not going to recognize them. They are full transaction for that new year, but they are not the transaction for the year that has come to an end. And it is on this note that I'm going to, I will appreciate it if you can release me so as to meet up with demand service. Thank you so much. Thank you for your rapt attention. I appreciate all of you for the opportunity given to me.
Thank you. Thank you very much, Alaji, because there's something that is coming up because of our time. And, you know, today's public holiday, apart from those that are fasting, we have had 4 hours already since we started. Who is that making something there, please? So I will discuss with you later today. The last 2 papers which you are supposed to take will not come up again today, but I will discuss privately with you. Is that okay, sir? Mr. Ayuba? Okay, maybe he has left. Okay, we'll make an arrangement for that so that we will not spend too much time today. We'll go to the next paper. Somebody is raising up his hand. Is there anything urgent before we quickly go to that so that I can attend to that before I begin the next paper?
Please, are we going? Hello?
Yes, I can hear you.
Hello? Yes, I thought this is the final paper for the day. I thought this is the final paper for the day.
No. We have paper more today, and she's starting now. All of them, okay. 1 hour 45 minutes.
Okay, 1 hour 45 minutes, sir.
Yeah.
Okay.
And so that we close for today. All right.
Okay.
Thank you.
Thank you.
Ladies and gentlemen, Mr. Ayuba, you can stop the sharing of that this particular one.
Share. You can stop.
Let me see. Let me see if I can do that. No, I cannot. Let me see. So that we'll be able to. Oh, okay. What's this now? So that another person will be able to share. Let me see. Just 1 minute. I don't know that he's leaving immediately. I will have asked him to do that so that the next person will be able to share.
Okay, let me get across to him
think
and
I
tell him
will-
to share.
Or I don't know which one because he's using two devices. I don't know which one is, so that I will just remove him from one of these places. Okay, if you have access to it, kindly help us to do that while I read the profile of the next paper presenter. Yeah, the next paper presenter, she's a lady and one of the members of our institute, and she has been with us for some time now. So Oluwatobi is a member of institute, like I said earlier on, and she's also qualified as accounting technician associate, AATWA, and she holds a bachelor degree in accounting and also master degree in finance from Lagos State University. Additionally, she graduated with HND in accounting from Yaba College of Technology, Lagos, and holds an OND in accounting from Osun State Polytechnic with upper credit. Demonstrating strong commitment to excellence, Oluwatobi has excelled as a trainer, facilitator, presenter through her career spanning several years. Her diverse experience includes 6 years in banking, where she gained valuable expertise and made significant contribution to the pension industry, reaching the position of senior supervisor. She's also served as a consultant in Proud Nigeria Limited, focusing on finance and investment with role encompassing responsibility as an accountant and consultant. Toby's dedication to continuous learning and professional development is evident through our role as the founder of Knowledge Quest, an online training group, which I believe that experience will be demonstrated this afternoon here. Through Knowledge Quest, which she founded, she conducts monthly training sessions, providing valuable insights and knowledge to professionals. And additionally, she serves as a permanent resource person and moderator of events for Youth YP Foundation, where she focuses on delivering exec training from basic to advanced level. Currently, she serves as a senior associate of SIAOA Partners, a well-regarded audit firm. Her proficiency in accounting and audit application includes 650, QuickBooks, and Excel at both basic and advanced level, as well as Power BI. He is instrumental in her professional achievement. Oluwatobi finds joy in connecting with people and exploring new places. Ladies and gentlemen, welcome on board with me, our next paper presenter that will take us through IFRS 15 and IFRS 16 all together. So welcome me, Oluwatobi, to take us further in this section. Toby, are you there?
Yes, I'm here, sir. Good afternoon.
Hello, Toby.
Hello.
Will you be able to share your screen?
Yes.
Can you share your screen?
Okay.
Okay, please do. Please do. Is the sharing button active?
Yes, it is.
Okay, perfect.
Can you see my screen?
So we have.
All right.
Yes, it's feasible. We have limited time. Please rush and let's move.
All right. Okay, thank you very much, sir. And thanks for having me Good afternoon, everyone. Thanks for participating. I'm excited to be here this afternoon. And I also appreciate all participants in light of Folusho Ilori, Arole, Balogu, Asil, and Co. I have a long queue here. Thank you very much for attending. And then welcome once more to the training section, which is IFRS resiliencies. That is renewed insight for chartered accountants. And then to all FCAs on this platform, I know my FCAs are loaded with a lot of practical experiences, and then this will enable us to have a real life talk on this topic, IFRS 15, which is revenue from contracts with customer. So what are the challenges we are facing in recognizing revenue in that your little business for service rendered to clients and customers? So you need to bring it to the table this afternoon, because I strongly assume that we have a professional here with a potential solution. So at some point, we will be having a real-life conversation, a real-life talk on the revenue recognition challenges and then potential solutions. And then to all participants present here today, I want us to be rest assured that we are all here to learn, unlearn, and relearn. So thank you all. One of the biggest and hardest accounting issue whatsoever is the question when and how to recognize revenue. And as a professional, we understand the critical roles that accurate financial reporting plays in decision making and building of trust with stakeholders. A short story. Let's meet Emily, an event planner. She's all about making events extra special for clients. Before she gets into IFRS 15, which is revenue from contract with customer, Emily will book revenue immediately, a client size and agreement, no matter where the actual event takes place. And upon embracing IFRS 15, Emily approaches changed. And instead of recognizing revenue straight, Emily learned how to identify single performance obligation. I know someone wants to ask me, what is that performance obligation? Performance obligation is one of the specific things that a business promised to do to its customer. And as an entrepreneur in the house, I know we have a lot of entrepreneurs in the house today. As an entrepreneur, that service you promise to render to your clients is your performance obligation. So she started recognizing revenue over time as her team deliver each aspect of events and customers are satisfied. So IFRS 15 helps her create a true picture of how well her business was doing. Now, she can now show the importance of each event in the company's finances. IFRS 15 is not a challenge, but is an opportunity for financial leaders like you and I to display our commitment to accuracy. So good afternoon once more. My name is Oluwatobi Okoma. I currently hold the position of a senior associate at SIAO Partners, where I utilize my expertise as a chartered accountant. And then my experience cut across different areas such as accounting, training, facilitation, and consultancy. And throughout my career, I've been heavily involved in training professionals, which has equipped me with a valuable skill set that I'm eager to share with you all today. Oluwato will be your trainer for the next 45 to 1 hour or less. So I'm excited to be here today, and a big thanks to my Oga at the top for this wonderful opportunity given to me to showcase my insight and expertise, and thank you all for having me. So we are going to go into a discussion table, as I said earlier, before we move into the presentation proper. I will need the advice seeker to be welcome on board, and I believe that we have an experienced professionals that have solutions to that problem. I know we are all familiar with the standards as a professional. Fine, yes. We know the 5 models of recognizing revenue. Fantastic. We can even memorize it. It's possible. So how can you be able to apply it in your day-to-day activities matters most. In just practical words. Some business are so complicating that it's even difficult to identify the revenue streams, and not to mention recognizing them according to standards. You know, compliance with standard is not just meeting requirements. It's about building trust, engaging transparency, and upholding integrity in all aspects of your business. So let us hear from you to achieve this innovative standard that brings about changes in recognizing revenue. So the floor will be open for like 10 to 15 minutes. My apologies, we want to have a conversation before we go into the presentation proper. So the floor will be open for like 10 to 15 minutes for us to have a discussion. So please, the floor is open. I want the advice takers to talk. Let us know what you're facing, the difficulties you are facing in your business. Hello? Is anybody
Is that
talking?
the question?
Yes. What are the
question for
challenges
people to contribute?
in recognizing revenue in your business? That is the question. I want it practical, because we have CFAs here that can answer that question. So let us come on the table to discuss.
Okay. Do we allow people to talk or to put it on chat?
Yes. The discussion table. Yes, we need to talk. Yes.
Okay. So whoever that needs to contribute, you can just submit yourself and do that within the few minutes provided.
Yes, someone is raising
We
hands.
now have
Someone
up to 15 minutes you mentioned, but within 5 minutes we should be able to do that. Okay. That person should unmute himself or herself and make contribution.
Hello, good afternoon, Mars, and good afternoon, Sans.
Good afternoon, ma'am.
Okay, yes, I want to use our line of business, our line of operation as a case study in this case, because it is not the regular buying and selling. We are into loans.
Is that where you work?
Yes, sir. We are into loan, like we give loans to clients. And she said that we should identify our simple performance obligation. I feel that our performance obligation is, if we have promised a client that a person is going to be credited, and we have credited that client, for instance, can we go ahead and recognize the total expected interest as our revenue at that point? Or we have to make provisions before we recognize the balance as our revenue? And in a situation where the loan, for instance, is going to last for more than 12 months, that is, it's going to lapse into the next accounting period.
More than one
How do
financial
we
year.
recognize our revenue?
Yeah. Okay.
Yes,
that's one
in
point.
the house.
I think it's better you note it. It's better you note all those points together, right. Then we can address it at it. Is that okay? Okay. Any other person? Anyone again? Do we have any other person? Okay. Yes, unmute yourself, Mohammed.
Yes, in case of non-profit, if you have a commitment to donate that lasts over several years, or just do you recognize everything that year? Let's say you have a commitment to donate ₦1 million over 5 years. Do you amortize it? I mean, or do you recognize 4 million that year?
Okay. Are you noting it, Toby?
Yes, sir, I have. All right.
Okay, another person, another one. Please submit yourself and make your contribution. Who is this next person? I'm sorry, I don't know. Let me see the name very well so that I pronounce it
Good
well.
afternoon. Yeah, good afternoon, everyone.
Okay.
Good afternoon, moderator.
Good afternoon.
Everyone. Please, I have this
What's
question.
the name so that I can understand how to pronounce it?
Adomokai Tosin.
Okay.
Adomokai Tosin.
Go ahead.
I have this question.
Go ahead. Go ahead.
The recognition of revenue for my company. Okay. As the person in charge of revenue in my company, as the manager in charge of revenue, I usually have some itches and a little bit difficult in recognizing some of this revenue. And that revenue is, they are specifically for some customer, you know. When you are recognizing revenue, number one, there's agreement between the two parties there and there, the PO, whatever. Now I have this particular customer. Whenever they call for item, they need the item for their equipment running. They will just tell us, oh, please, can you furnish us with this is so equipment, there's also spares. We need it for running of our machines. So they go ahead, they pick 1, 2, 3 spares for some period of time. Maybe in January they will pick, in February they will pick. Why? And their government body. Why we are waiting for the PO and we have delivered. They've acknowledged that they collected those items. And if they don't give us PO, they won't pay the money. Even if, in quote, I'm carrying this item that have been collected on my receivable, they won't pay us until PO is gotten. And some of the time, what they do is they will do all the spares they've collected for some period and accumulate everything in one PO and give us the PO. So everything will be leaving our inventory, will be leaving our inventory, and I'm unable to recognize it because even if for example, I recognize it as 10 million, by then their PO is coming out, maybe their PO is coming out as 20 million. So if I recognize 10 million, if auditors form, your PO is reading 10 million, you are your PO is reading 20 million, you have recognized 10 million. What is causing the difference? So I don't know. I'm always having difficulties recognizing revenue for that particular specific type of customer, and they are collecting my inventory. They are collecting some of all these things, and I'm unable to recognize, or I don't know when to recognize their revenue. Though I have on their invoices with me stamped with their company stamp, saying as received that they've received those items from me. Yes, they have received it. But if I don't get PO, I can't process payment in their company, their government agencies. Thank you.
All right. That's noted. Another person, please. Let's do it.
Yes,
no, this forum is not meant for just 1 minute. It's not meant for this particular presenter alone. It's for most of the professionals that are here so that we can have an interactive session, to share knowledge and share our ideas together. Okay, so it's good that we are bringing all these things together for all of us to, to work it together. Yeah. So briefly, go on.
Okay. Good afternoon, everyone. Good afternoon.
Good afternoon,
everyone.
Good afternoon.
Yeah.
Good afternoon. Yeah. Good afternoon. Go ahead. Go ahead. We can hear you.
So, demand notice for our revenue. Yeah, we do give a demand notice for our revenue. And when we give demand notice, some of them we pay, some will not pay at that particular year. So my issue is that the ones we recognize the revenue for that particular year. Okay.
You have to come again. Your line is breaking.
We do issue demand notice
Okay.
Okay.
Oh, we can't hear
Can you hear me
you.
now? Okay, no problem. I'll ask the question later.
Okay.
Or maybe you put it on the chat box. You can read it. Who else again?
Okay.
Mr. Sophie or Matt.
Okay.
Put it on the chat
Good
box.
afternoon.
Type it there.
Good afternoon.
Good
Can
afternoon,
you hear
sir.
me, sir?
Is it a
Can you hear me, please? Yeah, it's a woman. Can you hear me, please?
Yes, we can hear you clearly.
We hear you.
Okay.
Yes,
My own
Yes,
question is
we
this.
can hear you.
Okay, thank you. Concerning revenue recognition, okay, where I work is a manufacturing company. They're into stock items, and it's basically on cash basis. But where the issue is, why I'm asking this question is this: in as much we know that it is when it is being paid for, that's when you issue out the items, we know automatically immediately. But there are some customers, for example, if the item they are meant to buy now, it's 200,000, they might decide to pay 500,000 and pick 200,000 item at a particular period. Now, the remaining 300,000, they might not pick it at that time, of which they'll pick it later. So in that situation, and that later most times costs the price at which, or the cost implication on the item at the time they pay has changed by the time they'll pick it. So in that scenario, how do one recognize such revenue? I know it's always meant to be after the item has been concluded, but in this scenario now, when some are to be taken and some is yet to be taken, so what is the best way to recognize such revenue? Thank you.
Thank you.
All right.
All right.
I think we don't have anyone left again.
All right. So
over to you, Toby.
Yes, sir. Thank you very much, sir. Yeah, thank you all for all your questions. Yeah. I know after this presentation, all your questions, I know the curiosity is going to be resolved. So let's go to the presentation proper. Guiding you through this topic, we will cover various aspects, which includes the overview of this topic, which is IFRS 15, the benefit and scope of IFRS 15, the first-step model for recognizing revenue, and which is identify the contract with customer. Step 2, identify the performance obligation. Step 3, determine the transaction price. Step 4, allocate the transaction price to the performance obligation. And the last step, which is recognize revenue when and as the entity satisfies performance obligation. And then we are still going to look at revenue recognition and disclosure. Then lastly, we talk about contract costs. And by the end of this training section, we have a comprehensive understanding of what IFRS 15 is and its components. So the overview of IFRS 15. In the era of IAS 18, which is revenue, there are so many challenges being identified, which is complexity in contract accounting, inadequacy guidance of services and other revenue, difficulty in recognizing revenue from services, limited disclosure of recognitions and other issues. So, to clear up this confusion, the International Accounting Standard Board, which is IASB, collaborated with the Financial Accounting Standard Board, FASB, to base a new standard, which is the International Financial Reporting Standard 15, commonly known as IFRS 15, which is revenue from contracts with customer, which effectively came off 1st of January 2018. And from that day, all previous standards was suspended. So what are its objectives? The next slide. What are its objectives? Number 1, is to establish a single combination standard for recognizing revenue in various practices. That is, different companies have different recognition of revenue, which can be so confusing. So by having one way of treating revenue, make it easier for companies to recognize and understand revenue. So the number 2 aspect of it is to provide clear and consistent principles for recognizing revenue. This means giving a straightforward consistency rule in recognizing revenue instead of each company having their own way of recognizing revenue. So what are the benefits of IFRS 15? What are the benefits of IFRS 15? Number 1 is to enhance advice drawn from what? From transparency principle. That is, it makes it easier for people to make decisions on what? On financial statement. Because when there is a clearer principle, to make decisions will be very, very smart and clear. And number 2 is what? To improve disclosure. That is, giving a clearer picture of the financial statement for better decision making. And number 3 of it is to compare revenue information across companies. That is, comparability, benchmarking. So it assists organization to benchmark performance with what? With similar organization, and also what? To appraise their performances. So what is the last benefit here? It's that it also serves as a reliable framework for decision making. That is, it enables decision to be based on what? Solid principle that can now lead to what? Better outcome. So let's go to the next slide, which is the scope of IFRS 15. What are the scopes and exemptions of IFRS 15? What are the scope and exemptions of IFRS 15?
Can you make your slide presentation mode?
Okay.
Your slide.
Are you seeing my screen? Is my screen visible? Okay,
we are seeing it. We are seeing it. It's visible. Okay. Yeah. So that
you can see your screen.
Presentation mode.
All right. Thank you.
Continue.
All right. All right.
Go ahead. You can go ahead if that will disturb your.
Yes, I think it's fine now. So what are the scopes and exemptions of an IFRS 15? IFRS 15 applies to all contracts with customer with some exemptions. Number 1 is a non-monetary exchange between entities in the same line of business. That is a barter transaction between entities in the same line of business and what are excluded from IFRS 15. Number 2 is certain non-monetary transaction, that is transaction that are not in exchange for consideration, such as donations, contributions, and not within the scope of IFRS 15. And then the last one here is financial instruments and the other standard, that is a contract that falls within the scope of other standards such as IAS 39, IFRS 9, financial instruments, or IFRS 16 for leases, and what are not in line with IFRS 15. So we are going to the main topic for today, which is the 5-step model for identifying revenue. The 5-step model for identifying revenue. Yes, the most important thing IFRS does is that it introduces 5-step model for recognizing revenue, which have number 1 step is to what? To identify contracts with customer. Number 1, identify contracts with customer. And number 2 of it is to identify performance obligation in the contract. Identify performance obligation in the contract. And number 3 of it is to determine the transaction price. Number 3 is to determine the transaction price. And number 4 of it is to allocate the transaction price to what? To the performance obligation. And the last step is recognize the revenue when and as the entity satisfied the performance obligation. So, if you want to determine how and when to account for revenue in your particular business or transaction, all you need to do is to go through this 5-step model according to IFRS 15. If you want to determine how and when to business, all you need to do is to go through the 5-step model under IFRS 15. So let's take a brief look at each model. Let's focus on the first model, which is identify the contracts with customer. Hope my slide is still visible.